Saab, the third quarter numbers beating the average analyst estimates. They still see organic revenue up between 15 and 20%, so we'll watch how that one performs. And Maersk in focus as well, the shipping business. Again, ADR's doing well, this time in session over in the United States, increasing their guidance for the fourth time then, Guy, in less than 6 months.
Let's take a look at how this open is going to unfold here in Europe this morning. I think initially you may see a little bit of a positive pop. FTSE 100 may be excluded from that. Right, time for the numbers, time for the opening trade. Here we go. Let's take a look at what we are seeing. Does the higher cost of money matter? Does the discount rate matter to global stocks? I think we're going to find that story out over the next few days. But at the moment, the FTSE 100, as anticipated, we are seeing a little bit of softness creeping in. So just kind of see whether that continues to gather pace. The 600's absolutely flat at the moment. I think, to be honest, so is the FTSE 100. We're going to have to wait and see exactly how the DAX opens. I suspect this morning it may take a little longer than it has done over the last few days. Today we have some news. You've got to factor in as well the car data that we've seen out of Europe this morning. So the 600 turns negative. We're waiting for the CAC. We're waiting for the DAX. We're waiting for the SMI. We're certainly waiting to see how SAP trades this morning, and Maersk as well, Critty. So what's going on below the hood?
So I think we're still waiting for some of the opening trades around SAP, but you are seeing it in some of the other companies that trade in line with SAP. ASML, of course, is going to be your biggest index contributor this morning, higher by about 1%, Anna, right next to a slew of other movers as well. To me, I think what's standing out when you look at this picture is that healthcare seems to be on the back foot when you look at some of the kind of underperformers in the stock 600. You're also seeing a move when it comes to the defense sector as well. Saab, right out of the gates, I should say, higher by about 4%, but broadly, outside of technology and outside of basic resources, red on the screen.
Right, so technology and basic resources, you're right to highlight to the upside. So those are the sectors that go higher. Interestingly, real estate is the worst performing sector today. Does this take us back to the higher for longer rate story that we've been talking about? This is, you know, this was to the conversation we were having earlier. Europe can set its course. Europe wants to cut rates from here in various geographies and has been doing already. What happens if the US pauses either next month or sometime in 2025? What kind of influence across the Atlantic do we get from that? Maybe that's the thought process around real estate this morning, because that sector is underperforming, along with some of the other bond market sort of proxies, utilities and telecoms.
Yeah, exactly what you would normally expect to see. Higher cost of money. You see some of these bond proxy sectors. That's where the impact is going to show up most significantly. Is it good for the banks? Does it change the net interest income story? Is that going to be maybe a positive tailwind in a way that we hadn't anticipated? We were anticipating the rates were going to be coming lower. So maybe that's the kind of the flip side of that trade, that we could see European banks benefiting from this, despite the fact that we're actually anticipating a easier monetary path.
You can get it. We'll get Jamie Dimon on the phone. You can start that conversation with him. Do you want to, Guy?
Yeah. Have you got his number?
For all the details about that one number. He enjoyed that very much.
SAP is now open. Look at that, up by 5.1%.
Yeah.
Big pop out of the German company. It is feeling the impact of the European slowdown, but we are not seeing it, obviously, in terms of its numbers. The AI migration, the cloud migration story is certainly driving that stock higher this morning. Is it Europe's most expensive company again? I don't know. We'll look at the maths on that.
I'm going to let you do the math on that. I was a history major, so I'm going to back out of that one. But I think it's worth saying the German index is now the outperformer on the entire continent as well. You are seeing the FTSE 100 be the underperformer. French stocks are taking a massive hit, though, down 1% on the entire index. We're going to do a little bit of digging and see what is the biggest weight on that. I believe Sanofi, some of the healthcare names weighing on that story. But let's take a step back here and talk about what the bull case for Europe actually is if we're trying to figure out where we are in this economic cycle. We had that conversation with Goldman's Christian Muller-Glissman yesterday. Take a listen to what he had to say.
The good news about Europe is it's not late cycle at all. So if you're worried about overheating ever again, I think Europe won't overheat. You see proper disinflationary momentum. That's great. I think we know disinflation is to some extent good for bonds and can be good for equities if growth is good. We've just downgraded in this earnings season our top-down earnings growth forecast for this year to kind of 2%. So we were at 6% before.
A really interesting one, perhaps, reason to be positive about Europe. Let's get another perspective here. Piers Hillier, CIO at Royal London Asset Management, joins us around the table. Good morning. Before I come to you, I just want to quickly mention that the CAC is now open. It is down about 0.3%. I misspoke. It took a second for some of the market plumbing to work. We are going to still wait to see how that shakes out. But the point still stands, which is that it is kind of a gloomy backdrop in Europe at the moment. There is an argument about maybe we are late cycle, maybe there is a reason for some sort of reflationary trade to show up in Europe. Are you optimistic about this part of the world at all?
Well, it's certainly easier for the central bank governor to talk about cutting rates in Europe in terms of the inflationary backdrop here. One of the things that we've been really keeping a very close eye on ourselves is wage inflation. So most of the anticipation in rate cuts was driven by the rollover in the CPI originally, and then you had the goods following behind. But the stubborn bit in some ways has been wage inflation. That's been evident certainly in the UK and in Europe, and to a degree in the United States in terms of employment data. So for us, that weakening of wage inflation demand in Europe certainly makes it easier for Lagarde to make the case for cutting rates in Europe. It makes it harder in some ways for Bailey here and the Fed to move in the States.
Does that, though, create almost a capital flow question of that maybe the outperformance in the United States is not always necessarily measured on fundamentals or valuations, but simply this idea of running for safety at the expense of flows in Europe?
I think ultimately, it's interesting. You've got companies reporting this morning. I've been an equity fund manager for most of my career. It's really for us when we look at investment. It's a message you're getting out of the companies in terms of the backdrop for investment, where they see the opportunity for returns, and you're always trying to get the balance right in terms of the macro backdrop. Is you've got a tailwind or are you running into a headwind, and how you manage effectively your revenue cost trade-off. So for me, the positive side is that the macro backdrop is certainly favourable in terms of I still see us in a declining rate environment. The near-term stresses I can understand is that you've got two critical things coming up. You've got an election in the United States, and to be honest, for me, it's not necessarily who wins the White House. It's a question of whether do you have the same colour in Congress as you have in the White House. And if that's the case, then you've got inflationary pressure, and then that's what the bond market really started to price in yesterday. Here in the UK, for example, we've got the budget coming up at the end of October. There's a real trade-off in markets' view here as to are we going to see the sort of fiscal pay for us as consumers in the UK, but actually a stimulus in some ways in terms of encouraging inward investment to the UK, and that's where the trade-off sits at the moment. So for me, ultimately, we'll come back and look at the fundamentals of the companies that we invest in, whether we're lending to that company or whether we're investing in the equity. But the macro backdrop is probably more choppy than it's been for a long period of time, and we haven't even talked about the energy complex and the sort of geopolitical risk as well.
Do you think bond yields in the States could go 10 years? I'm talking here could go back to 4.5. Could they go back to 5? Could they go back to 6? If they do, what is the impact? What's the impact on equities?
So I think that funny enough, we were talking before we formally came on air. But one of the things that's been really interesting, particularly in the last month, has been a significant issue of refinancing of corporate debt. And I think for me, one of the things we were a little bit worried about, and we've been probably maybe overly cautious about default risk, and that's because if you go back to 2021, pre-interest rates going up, there was a lot of refinancing of debt and terming out of debt structures at a corporate level. And we were seeing that as this sort of refi wall that was going to come late this year, but really 2025 is going to be the sort of focus, and that's where default risk was rising. Well, a lot of that is being drawn forward. I mean, we've seen 42 billion of issuance in the UK in October alone, to give you sort of some sense of the numbers. And so for me, what's been interesting there is that actually there has been an appetite for assets and that reinvestment. And so some of that pressure abates. So to your point about rising long bond yields, that's really a reflection of what does the macro set from a government perspective, whether it's the US or the UK, that will move, and that's what's adjusting the long rates that we've seen most recently. In the nearer term, though, we've seen that move at the front end, mainly because is that balance between the stimulus you get from the government versus the central bank rate cutting cycle. We still think that there's a scope for rate cuts. We've always been in the camp that actually it would be higher for longer, it would be a slower rate cut, it would be data dependent, all those phrases that people use. But what's really changed, I think, in the last month is this been view that actually we're not going to see as much of maybe the sort of spending discipline, which is why the long end of the curve had come down. Now, I think at this point, we kind of think you're starting to see value at the longer end. To your point, do we get to a 5 handle? Do we get to a 6 handle in the US? Probably too high from my perspective, but certainly could you see 5 in the UK? Yeah.
If I get to 5 in the States, do I buy or sell stocks?
Well, I think you'd be buying bonds there. I think ultimately, for us in stocks, when you get that kind of interest rate move, the thing you've got to really think about as a company is there's the operational leverage you have and there's the financial leverage. And the bit that we were concerned about in that very sharp move in rates in 2022 was you're going to see financial leverage really kicking in for the first time in a considerable period of time. And that, to be honest, hasn't happened. Companies have been disciplined about generating cash and paying down debt. And so that's the bit we'll look at. So companies that have lower margin, with lower pricing power will be impacted in that environment. But actually, good businesses in environments where there's strong structural demand will be able to manage through that. That cost of capital assumption is what they're paying in bond markets today. Yeah, and they'll just think about how they finance the business more sensibly.
So those businesses are a bit less impacted by a slightly higher rates environment than you might have feared, I suppose, is the conclusion. What about the earnings story then, Piers, and where that takes us from here? Because when we were speaking to Christian Muller-Glisman yesterday, he was really wanting to return back to expectations around earnings and how maybe some of the valuations are justified by earnings expectations. How concerned are you about some of the valuations in the US, or are you not?
Well, I think we tend not to use PEs, mainly because I'm an accountant by background and I kind of know what you can do with earnings to make the numbers be the numbers. So we look at basically free cash flow conversion within a business and what the actual return on that capital has been. If you think about it, if you notionally put £1 in the bank, what interest am I going to get paid? Exactly the same philosophy when we look at companies. And then we say, okay, what's priced into a share today? What do I have to believe in terms of returns going forward versus historic returns within the company and the discount rate? And from that backdrop perspective, actually, we do continue to see opportunities to invest. It's not as though we're scarce. And the big question I get asked lots and lots of times about technology companies. They all seem to run away. There's a massive sort of enthusiasm around AI, and to a degree that's been true. But Nvidia is a question I get asked time and time again. If you look at the backdrop fundamentals in terms of cash conversion at Nvidia and the growth of that in the last year, the share price movement has been justified. The last movement in the last sort of 2 to 3 months essentially has really been sort of the topping out, which is the multiple expansion, and that's where we tend to get a bit nervous.
Right.
Is that you move away from fundamentals. And then I think the other thing I'd throw in at this point is that ASML last week, I think, was a really important indicator, which we need to be alive to. SAP, an interesting contrast this morning. But ASML, I always think, is the sort of start of the process. If you think about what pulls you through to the chip space and the demand through to AI, it's ASML that produced that hardware side of the picture. And there was a pretty downbeat statement from them last week. Now, they're speaking at a conference today. It's always interesting to actually speak to the management and really sort of understand what do you see the structural drivers. It's just a near-term order shortfall, or whether it's something more significant.
Yeah, it seemed to be that we are sort of dissecting the chip businesses into two: the ones that are really going to fly with the AI theme, and those that are maybe going to be a little more held back by the more cyclical, underlying consumer technology sort of facing businesses. I want to ask you, Piers, about emerging markets, because if the markets are worried about Trump, from a bond market perspective, I say worried about Trump maybe. If you're pricing in increasingly the possibility of a Trump presidency, does that lead us towards emerging markets or not? What? I know you're quite positive on EM, so what underpins that?
Well, I mean, and we haven't been for a long time. I think I've met you many times before, and every time I walk in, I'm Dr. Doom and Gloom on emerging markets. And that was really partly the interest rate environment. Is emerging markets struggle when the cost of capital changes, particularly when it changes as quickly as it does, and that's why it's underperformed as a complex, particularly in the last 3 years. We started to become more optimistic on emerging markets earlier this year, mainly because I think there was a recognition that a problem in China needed to be resolved. And the second one really was that if you've got an environment where you structurally believe that rates are going to come down over time, that tends to be supportive of emerging markets. So we're having that discussion at the moment in some ways. If the bond market is now starting to get a bit more nervous about that rate cutting backdrop, then we need to be alive to that. But the stimulus that's being talked about in China and the feed through of that is one that balances our view. At the end of the day, I come back to the point, we'll look at the bottom-up stocks and the opportunity sets that exist in those marketplaces.
Piers, great to see you. Thanks for stopping by. A little bit more positive. Nice to see you. Piers Hillier, CIO at Royal London Asset Management. Thank you very much indeed. Core 6 looks like this morning. This is the picture in Europe we're watching so closely. We are, of course, keeping an eye on SAP and on Maersk. It's interesting that LVMH and Ferrari are both positive. ASML is also ticking up a little bit this morning. Schneider's a little soft. Nova's a little soft as well. Nestle's down a touch. That's what the kind of the core of the European equity market looks like.
Yes, and we're getting some new guidance coming through from some heavyweights across Europe. So let's get an update on how the individual stocks more broadly are moving. Joe has that. Joe.
So SAP is the best performer on the entire stock 600 today, gaining around 5% at the open in Germany. Remember, a surprise upgrade to their guidance in terms of both the cloud revenue and also the boost coming through from AI and some of that business as well. So leading their gains this morning. Logitech also in technology, getting a boost from their video gaming hardware, according to most analysts on that one. The surprise, though, is probably AP Moller-Maersk actually coming down slightly despite another upgrade for the shipping company's earnings guidance. Most of that is driven by the higher freight rates, potentially the demand not looking as strong as it could be in global shipping. So that one actually declining very slightly. But Saab over in defence, extending the gains for the year, already up around 40% for that stock. And they are seeing a big jump in orders in terms of the defence company today. In terms of the UK, a couple to bring you IHG, the Premier Inn owner, actually seeing a bit of a decline. Holiday Inns are seeing a bit of weakness over in the US, also China as well for that company. So that is coming down in terms of the stock there. Halfords, meanwhile, recovering from a slump earlier in the year, warning of a bit of a weakness, but mostly due to the poor weather in the UK. So getting a boost in terms of UK retail. One stock actually slamming this morning, slumping, is Eurofins Scientific, down 13%. This is a lab technology company over in France. Some really weak numbers out of them. And also might remember that this is a short target following a report from Muddy Waters. They released an audit today basically denying all of the reports from Muddy Waters, but the earnings really taken the toll on that one today, down 13% over in France. In terms of the autos, we got some strong numbers from Traton, the truck maker. Did have weakness out of some rivals, including Daimler Truck a couple of weeks ago, but that one actually gaining it today. And we did get some numbers on the European car sales. Once again, registrations looking pretty weak across Europe, but that potentially priced into the shares, so seeing gains in that sector this morning. Then finally, just wanted to bring you ING because that one is taking a toll. Barclays downgrading it, saying potentially the buybacks at the Dutch lender might be at risk as interest rates come down. So we are seeing ING falling around 1% over in Amsterdam this morning.
Joe, thank you. Joe Easton from our equities team. Just want to bring you some live pictures we're getting coming through to us from Israel. Anthony Blinken, the US Secretary of State, has started his 11th visit to the Middle East in what has been so far a fairly unsuccessful effort to try and bring about a ceasefire between Israel and Iran-backed militant groups. That's the 11th trip since we saw the attack on Israel more than a year ago, October the 7th last year. So there we are, Anthony Blinken arriving in Tel Aviv. Coming up on the programme, more on Maersk after it raises its guidance for the fourth time this year as Red Sea attacks and the fear of them has sent ships around the long way. We will talk about that next. This is Bingo.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. covers earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Earnings season is here.
And once again, we find ourselves asking whether the earnings season can live up to expectations.
Bloomberg is first to break the numbers.
Just crossing the terminal, we have results from Heineken.
Getting SoftBank out. Glencore numbers are dropping as well.
I'll quickly mention Diageo because those numbers are coming out.
Smashing the estimates.
With the smartest insights.
What are you most looking forward to the second half of the year?
We've lifted the margin guidance for the year, so it's going to be good.
We will, of course, be bringing all the details.
Continuing coverage on Bloomberg.
Good morning. Welcome back. You're watching the opening trade. We're 21 minutes into the equity market session this morning. I can tell you that SAP is now worth more than ASML. I just point that out for interest if you happen to be focusing on those two stocks this morning. Maersk is another stock that you probably want to focus on as well. The shares are gaining. This after it raised full year guidance for a fourth time in less than 6 months. The container company, the giant container company, seen as a bellwether for global trade, is citing stronger demand and higher freight rates caused by supply chain issues as a result of the attacks that we are seeing in the Red Sea. The stock is a little softer this morning, which in some ways is logical. Is it better to travel than arrive? It's perfect for this stock, isn't it? Christian Weinberg joins us now to discuss this, to talk about this. Look, in some ways, we should have anticipated that we were going to see this upgrade today. We still can't go through the Red Sea. There are still disruptions. There are still higher freight rates, as a result of which I'm assuming that the analysts had already penciled these kinds of numbers into the stock. Is that why we're seeing a little bit of softness this morning?
To some extent, it's not surprising really to see that happening with Maersk, and that has to do with the long-term prospects still being somewhat gloomy. We also saw it in the ADRs trading in New York overnight that they started up shooting up about 7%, and then they lost their steam. Probably due to the longer-term issues with container shipping being seen as soft and going into 2025.
Right, so that makes sense then a little, doesn't it, Christian? Why is it that, talk us through the sort of basics here about why it is that Maersk benefits from the disruption. I know that this means that these shipping businesses, these cargo containers have to go the long way around, which sounds expensive, but there's quite a lot of overcapacity, I understand, in the sector.
Exactly, and it seems counterintuitive, but you might also remember it from a few years back when a ship got stuck in the Suez Canal and blocked ships from coming through. That was also a boon for container shipping. And the reason is that it's all about supply and demand, and when you have oversupply of vessels, and then you absorb some of that overcapacity by having to divert the global fleet south of Africa, then you get the balance between supply and demand then tips in favor of the shipping companies, and that's what's happening with Maersk here this year. As you say, it's a little bit of a weird one to get your head around, because you would think that this would be bad for the shipping companies, but it's actually good for freight rates.
Well, good for freight rates, but what about the other costs that are involved, Christian? I'm thinking if it takes longer to get ships from point A to point B, taking the longer routes, that increases fuel costs, labor costs, safety concerns. Are any of those making a dent in any of these numbers?
Well, the main dent they're making is in CO2 emissions, obviously. It takes a lot of fuel to divert the global fleet south of Africa. The shipping companies are very good at passing on fuel costs to their customers. So for them, it's not a big issue with the extra fuel cost. It is an issue, but it's not a big issue. It's not, and the labor costs are also very small. These massive container ships hardly have any crew on them. So the labor costs involved in having spending more time at sea are quite small, actually.
Okay, Christian, good reminder. Thank you very much. Bloomberg's Christian Weinberg with the latest there on Maersk. Started out the day quite positively then on that guidance upgrade, but the stock just coming to the downside more recently. Another stock that actually I was going to say trading down, but it's pretty flat, is HSBC on its London listing. The new CEO, Georges Elhedery, then taking the business to task and restructuring the business. Some interesting restructuring into a number of sort of simpler number of units, reducing the number of executives on the board. It would
4
seem.
units, cutting the number of executives on the key boards. Feels very city-like. Jane Fraser obviously in some way pioneering this strategy, and it now looks like HSBC is going to be putting into action as well. It's basically trying to streamline the operation, take costs out. It probably means that we are going to see ongoing redundancies at this company, but it's a simplification that looks very similar to what we've seen over at Citi, and we've got our first female CFO.
As I was about to say, Pam Core, you can see the photo on the screen in front of you right now. The first in its 159-year history. I'm curious, though, I feel like we do, and you made this point this morning, Anna, that we are getting a lot of changes out of HSBC quite a bit. So I'm wondering if this is the end of them, or we continue to get more as they navigate the environment.
Yes, and restructuring requires restructuring charges, and there'll be more of that to come, no doubt. The changes are part of what's allowing the firm to cut more than 20,000 jobs across the company. So this kind of thing takes time, and we will watch as that plays out. We need to focus on the auto sector as well today.
We should focus on the auto sector. Car sales in Europe, it's not good. Once again, the first consecutive back-to-back monthly declines in more than 2 years. The region's economies continue to stagnate. Car sales are down. We've seen a little bit of a tick-up in the EV story. I wonder why that is. But we've already seen significant warnings coming out of a number of the German automakers. That is likely to continue. If you take a look at the numbers posted so far this year by names like Stellantis, they make ugly reading. And today's data just reinforcing that narrative. Anyway, when we come back, we'll get the latest on the troubled sector, and we also get numbers from Tesla this week. That should be fascinating too. We'll get the Elon Musk angle on that story as well. Anyway, all of that is coming up. Cars next. This is Bloomberg.
Names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
This is the opening trade. We're about 30 minutes into today's session. You are seeing green on the screen when it comes to the DAX, higher by 0.5%. Massive moves. They're not matched in the rest of the continent of Europe, and not even here in the UK either. The idea here simply being that some of these earnings stories out of Germany are actually coming in fairly, very strong. SAP, of course, taking the cake. There's some good numbers out of Saab over in Stockholm as well. A lot of that adding to the upside in an otherwise fairly gloomy day. And to add to that gloomy, let's talk a little bit about the car story here in Europe. New car registrations falling more than 4% in September compared to a year ago. As Stellantis, the owner of brands including Fiat and others, sales dropped 26% across the region. Let's bring in Bloomberg's global automotive editor, Craig Trudell, who is, of course, monitoring this data. Were you surprised by this, or is this just more of the same?
I mean, it is interesting to see. This is the first back-to-back monthly decline since mid-2022. So we've actually had, for some time, we had a real sustained period of growth for the industry. I think what's maybe surprising looking into these numbers, one of the sort of trouble points the last few months have been battery electric vehicles. We actually had a relatively solid month, I'm happy to report, for September, where roughly 14% gain for the industry, which is pretty solid. But what we did see was just some weakness in the rest of the industry, and we've now just seen a sort of fairly consistent up and down nature to overall sales, to where we're now only up for the year 1% through the first 9 months of 2024.
Is it priced in? You got GM this week, you got Tesla this week, you got Mercedes this week. We've already had some pretty good numbers coming out of other European autos. Are the US automakers in a different place than European automakers, or is this a global phenomenon?
I think maybe the global phenomenon for these international companies that is very consistent is the weakness in China. I think that's going to be very interesting to hear from GM later today. We've seen that consistently across the Germans. Even Tesla, I think, is maybe holding up better than some of these other companies, but isn't by any means sort of seeing the growth from China that they did in the past. And so, to the extent that they're having growth issues, it is, they're also part of this trend as well. That Tesla, was absolutely, growing like gangbusters there a few years ago. And even, on an export basis, the Shanghai plant is sort of tapped out, and they're not looking to expand manufacturing in that country either.
So we'll watch the China dynamic very closely for these global players. But what about the way that policy is helping or not helping in Europe? Because we saw EV sales drop off in places where there had been support from governments, and then that was removed. Now there's talk of support coming back in Germany, and you wonder whether that's causing some people to pause and not buy.
Yeah, I think that's an interesting thought. I do think that what we're also probably seeing is some holding back even by the manufacturers as we close out the year, because they need to hit higher CO2 emissions targets for next year. So Why rush your EVs out before the end of this year when you really need them in 2025? I think the other question in terms of policy-wise is I suspect we're going to hear a lot of conversations on earnings calls for the European companies about tariffs, right? With Donald Trump talking about, tariffs being the most beautiful word, his favorite word. That was a big point of emphasis, obviously, in the first Trump administration, and the potential for that to be a big risk for these companies is absolutely, I think, on a lot of investors' minds.
Definitely going to be watching that one. Great stuff. Thank you very much indeed, as ever, our global automotive editor, Craig Trudell. Earnings absolutely front and centre. Our next guest thinks more downward revisions are likely following the downside surprises we've already had from ASML and from LVMH. I may fold into this conversation as well. The downside surprises we've seen, were they really surprises from some of the automakers as well? Beata Manthi, Citi's head of European equity strategy, sitting next to us. You've got 5 frequently asked questions. The first one is, what is going on with earnings? So what's going on with earnings? Because the update so far is not particularly good.
It's not. It was always going to be a challenging reporting season. The good news is that it's the first reporting season in over a year that's supposed to have EPS inflecting, so growing for the first time. Analysts are expecting 2% growth.
Yep.
And for the next quarter, it's 12% growth, so that's the good news. The bad news is that there are lots of disappointments coming through, right? That was part of our story, of our assumptions. We've been noticing for the past 2 months deteriorating revisions from the analysts, from consensus analysts.
Yep.
So earnings revision indices for Europe have fallen around mid-September to recessionary levels. They've hardly ever been at these levels of negativity.
Is Europe bleak enough and cheap enough to want to be interested in it?
Perhaps parts of it, right? So European index, of course, despite all this pain underneath the surface, auto sector being one of them, and these recessionary downgrades suggesting that actually underneath the surface there have been EPS recessions for many cyclical sectors. Despite that, of course, European index is hitting all-time highs, right? That's a bit of a conundrum.
Way behind the States, but yeah.
So for me, coming back to your question, is it cheap enough? The index itself, it's fairly priced for what the analysts are expecting going forward. Parts of the index underneath the surface are very cheap, right? But then, of course, it's very cheap versus the US, and positioning is another issue we are looking at. European positioning looks quite subdued, while the US positioning is on normalized basis at maximum long you can be.
Okay. And Beata, thinking about what lifts Europe's prospects, I'm thinking about the China impulse and the stimulus we've seen there. You drew our attention to a Citi China exposure index. I think we've got the global one here on a chart rather than the European one, but it certainly demonstrates the point that you were making ahead of our conversation, which is that China, boomed on the announcement of the stimulus. It's pulled back a bit, but the global names that are exposed to that China impulse, they haven't boomed to the same degree. Maybe that's sensible, or maybe there's still some upside to play for. What do you think happens here?
Absolutely. So we call them China proxies, so developed market companies with big revenue exposure to China, and there hasn't been a proxy trade. Every time something happens out of China, actually the proxy trade does better than China itself. That has not been the case this time around. And what we notice is that there is a huge level of negativity and doubt whether Chinese authorities can lift the economy up from the...
Yes, and is that because is it because investors don't think that they can do anything that will affect the consumer, and these are all consumer-facing businesses, or is it a doubt about the medium-term rationale for increasing exposure to China with geopolitics playing out as it is?
I think it's more about the first argument, that China needs so much stimulus to start moving, but our economists think that it is actually more than anybody has expected. It's more and different in nature than we've been seeing before, so that's an upgrade at least. And even talking to the biggest bears on China, they admit that at least the floor is there, cyclical trough is there. And for equity markets, it's always about the balance of risk. So you've got to imagine that that's another tick off for things to start from very low levels improving. And then, of course, within these China proxies, there are many around the world, as you've mentioned. European ones are one of the most beaten down, really the earnings have gone down the most, the performance has gone down the most, and they tend to be most correlated together with Australian ones. So if indeed we get more, if market starts believing that more and more is coming, this trade could start moving.
It feels like we talked about this. We see this in, of course, the automaking sector. We see this in Germany. We see it in French luxury as well. But then French stocks have an entirely other regional problem as well. What do you need to see to be bullish on the French market?
So we are neutral at the moment in the French market, in our European allocation. And of course, so European market overall has been underperforming since around May, June. The US market having outperformed at one point at the start of the year even, right? And that has happened because earnings have started to go down. Very simple reason. The biggest downgrades within the European index have happened in France and in Germany, and also on the commodity side in the UK. I would like to see stabilization in the earnings front. Perhaps not inflection, well, that would be great, but I think the prices will start moving ahead of inflection. So the news flow this reporting season, very crucial, what is coming out of the French companies. Of course, we have other issues through politics there, tax hikes and so on, that they would put pressure on the overall EPS. That's not helpful, but inflection on EPS and getting the budget out of the way would be helpful.
Quantify that. How much pressure would those tax hikes put on? Or is this just kind of one extra cherry on top of a pretty bad Sunday?
The numbers are meaningful, but it is just another piece of negative news, right? So for this year, tax hikes by themselves would take away 3% of the EPS. For next year, just a little bit less than 3%. But of course, that comes this year on EPS that has already been under pressure. So French EPS, CAC 40 EPS is expected to contract by 2%, together with the tax hikes effect and on the top buyback effect. That would be below like -6 to -7 for this year. That's meaningful, right?
I've got two questions I want to ask you. Let me ask the first one. If we go 4.5, we go 5, we go 5.5 on a US 10-year, what does that mean for global equities? What does that mean for European equities?
It really depends about the setup.
Okay.
So if bond yields are higher, the Fed doesn't cut as many times as the market expects because the US economy is strong. I'll take it looking at equities, right? But some parts of the markets could see pressures.
Ben's going to shout at me. If the US, if the S&P does nothing for the next 10 years, which Goldman Sachs is predicting, does that mean that European equities do better?
I'm not sure whether the US is not going to do anything, but if over the next 10 years we have the environment of higher inflation and higher rates, I would argue it's an upgrade for cyclical markets like Europe. So yes.
Okay, there we go. To my producer, Ben, I'm sorry, but we have to get those questions in. Citi's European Equity Strategy, Beata Manthi, thank you very much indeed. Okay, coming up, we're going to talk about what's happening in Italy. The government there clashing with the high calls of the country once again. This over its controversial migrant scheme. We're going to get some more details of that story next. This is Bloomberg.
First of all, global trade, which had adverse consequences that we're learning about to this day still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar. They're leaders in EVs. They're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries. And those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage.
DOJ or other authorities
could face bigger challenges elected.
Was going to keep Rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Welcome back to the opening trade. 45 minutes into this session, this Tuesday, 22nd of October, and we see we're pretty flat across the overall equity market picture, but that hides a lot of divergence underneath the surface. The DAX doing pretty well out of some of those earnings stories, SAP amongst them. Let's focus, though, on Italy now, where the government has passed a new law to overcome a court ruling that blocked its plan to send asylum seekers to Albania. 12 migrants were returned to Italy last week after a court said they had originated from countries that could not be recognised as, quote, safe. Let's bring in our European economics reporter, Alessandra Migliaccio, with details. Alessandra, so has Meloni found a way through the legal difficulties here with regards to her Albania plan?
Well, we're not sure, actually. It's unclear, but she's certainly trying. She took a blow last week, as you said, because those migrants that she was hoping would be able to go to Albania in a plan that she's publicized very much, which has been praised in other European countries, because as we know in Europe, the migrant issue is big. It's been praised in countries like Germany, which is not exactly a friendly government to Meloni's, but they also have a migrant problem. And perhaps they have a bigger problem in a way than Meloni, because some of these governments want to keep the right at bay, and the only way to do it is make sure they fix the migrant problem and don't encourage voters to go towards the right for that reason. So Meloni's plan, which was so praised, which she was so proud of, had a big hiccup last week because of this issue. She passed this decree. She's hoping that now, because she's recognized 19 countries as safe countries, this includes Bangladesh, it includes Ghana, and several other countries, that now it will be harder for courts to block her move. But we don't really know if there are other issues, if they can really do this, which is take people that they save at sea and then bring them to Albania instead of Italy. There are a lot of still legal questions around it, but she's done an important step. She's taken an important step to make it a bit easier for the migrants to actually go to Albania and stay in Albania. So for now, it's a win, but we'll have to see what happens next.
Alessandra, as you were speaking, we were showing a graphic that showed the expected cost over the next 5 years to be about 670 million euros around this. Part of the opposition to this deal is saying this is a costly and ultimately ineffective deterrent. Walk us through some of the numbers here. What is the connection between the migrant story and the Italian budget?
Well, Italy generally doesn't have a lot of money to spend in general. I mean, it's a very, very big number, but consider the budget is 30 billion. So actually, it's not that huge a number, in comparison to what they're spending on many, many other things. But of course, when you have a deficit that's above 130% of GDP, every little bit helps. And since we don't even know if this migrant plan is actually going to work, it just seems indeed like wasted money. But she's going to give it a try. She's going to try again. The migrant centers are in part built in Albania. So I don't think this issue is going away. As far as the budget is concerned, it's a 30 billion euro budget, as we said. We're waiting for Meloni to tell us a bit more about it in another press conference, exactly how she's going to pay for it. They've given us a preliminary document showing that they're going to pay for it with cost cuts and with fight against tax evasion. But really, we don't have the details. We don't really believe that that's enough, to pay for all this. Out of the 30 billion, only about 10 billion are debt. So we're waiting for more answers from Meloni on that front as well.
Alessandra, this is a government that's nearly 2 years old. Is it as popular now as when it was voted into government? How is it faring? How is the population accepting what Meloni is doing at the moment? Is the migrant plan popular? Is what she's doing in terms of the economy popular? What is going on?
Yes, actually, surprisingly and fairly well. It's a stable government. She's managed to keep the rest of her governing coalition, because it is a coalition, it's not just her party, at bay. There are tensions repeatedly, but that's quite normal. We know that Italy is known for political tensions, and actually it's known for revolving door governments. It's quite impressive that she's held on so long without too much controversy. But it's a hard, juggling game for her, and so far Italians seem to be relatively happy with the stability that they're getting. So on that front, she's doing well as well. She was recently, the budget I said was a problem, but Fitch passed it, so she's doing better than we thought, let's put it that way.
It's interesting, isn't it? Like one of the more right-leaning governments, and seems to be faring fairly well at the moment. Alessandra Migliaccio, thank you very much indeed. Let's turn to another aspect of the political narrative that we're watching so carefully. 2 weeks, of course, to go until the US presidential election. The polls basically have Trump and Harris neck and neck. A Trump win could certainly stir memories on this side of the Atlantic of trade wars, and European policymakers are certainly getting ready for that. Alex Weber, our European economy reporter, joining us now on this story. What is the current thinking in Europe as to what a 2.0 Trump presidency would mean for the European economy? Why are we so worried? What is the anticipation?
So the biggest concern for European policymakers is certainly the ideas of Trump about trade. As you know, he's proposed to impose a 60% tariff on all Chinese goods, as much as 20% on everyone else. And the important point here is that even if he's elected into office and just the threat of new tariffs creates so much uncertainty that it will probably mean a sizable hit for the Euro economy that already isn't doing so well.
And Alex, so that's the backdrop economically. We look to the tariff story then to be implemented and really to be upped by President Trump in a second term. How much are policymakers reaching for the playbook of Trump 1.0, and how much are they saying, that's just not going to be enough because his tariff plans, for example, are much more extensive this time around?
Yeah, you're right. They're much more extensive. We've reported that the European Commission has drawn up a list of potential targets for retaliation should Trump win and impose these tariffs. But we also know that there are big differences between the euro area's biggest countries when it comes to how to deal with protectionism abroad. Just look at the recent decision to impose tariffs on Chinese electric vehicles that was opposed by Germany, for example. So that also creates a lot of uncertainty. Another problem is that governments now have a lot more debt than during Trump's first term. So that's also limiting their options and how to respond, which may well put central bankers on the front lines again. They have a bit more space to respond if the economy takes a hit, because interest rates are much higher now, but that's only limited comfort to them.
Well, Alex, you went right where I was going to go next about central bankers. Back in 2019, Jay Powell over in the Fed actively issued a insurance cut around concerns around the trade war. And I'm curious if there's still appetite in among European central bankers for something similar.
Yeah, there's probably not much appetite, but I don't know if they will get around it. So the ECB already had to accelerate an interest rate cut last week because the economy was doing so badly, because of weak consumption, weak investment. Those are exactly the things that would probably get hit again by another wave of uncertainty around trade. And that could mean the European Central Bank, for instance, might have to accelerate cuts further, or even go for bigger increments, bigger than 25 basis points.
Certainly something we're going to be keeping a very close eye on. Bloomberg's Alex Weber, we thank you so much for joining us this morning, putting into context and connecting the dots between this fiscal and monetary policy on both sides of the Atlantic. Of course, later today, it'll be a subject of conversation in an exclusive interview with ECB President Christine Lagarde. You do not want to miss that conversation at 3 p.m. UK time with our very own Francine Lacqua. In the meantime, back here in London, it is the Bloomberg Technology Summit. It is kicking off today. Our very own Tom McKenzie joins us this morning for more on what to expect. Tom, over to you.
Kriti, yes, we are joined at this summit by a number of CEOs, by a number of investors, including the Qatari Investment Authority, but also the CEOs of companies like ASML. That is going to be a highlight. That's coming up in the next 15 minutes or so. A 20-minute conversation with Christophe Fouquet on the back of that surprise cut to the outlook, of course, but also René Haas of ARM. Really interesting, of course, the Cambridge-based company, particularly given the news today around Qualcomm and its new chip designs. How much of a challenge will that be to the CEO of ARM? So we've got a combination of the executives, investors, and a part of that conversation, certainly from some of the other names on these panels, will be how to monetize this investment in artificial intelligence. That's been part of the conversation, I know, for you guys over a number of months. I think we may get some answers in the hours ahead.
All right, Tom McKenzie, we thank you so much, of course, joining us from London. He, of course, has those very crucial conversations throughout the rest of the day. Don't miss a conversation with the ASML CEO coming up in just a few minutes' time, as Tom mentioned there. In the meantime, a couple things to watch in today's agenda. We've got that BRICS summit that is kicking off in Russia today. And then we already talked about some of the other amazing interviews that we have. Christine Lagarde, of course, top of the pile. We want to keep an eye out for what Janet Yellen has to say over in the States as well. Though over in D.C., she's making some statements over the U.S. Treasury 3:30 p.m. time, alongside some of those defense earnings that are going to be rolling out.
Yeah, I mean, the defense sector certainly in focus. We had numbers out from Saab earlier, didn't we? And that stock's doing well on the back of their business, rising with bookings, cash flow looking strong, it would seem, for reasons we know very well for that particular business. And so that sector in focus when it comes to the earnings story. But a lot of macro themes. The BRIC summit, also worth watching because of the number of either heads of state or senior politicians that have gone there. More than 30 countries, actually, in attendance. And Janet Yellen will be speaking today. I wonder if she'll be asked about the dollar and attempts to circumvent the dollar in international markets by the BRICS.
I wonder if she's going to be asked about as well about what is happening in terms of the issuance story that we're going to be watching. That certainly seems to be front and centre for the bond market right now, amongst other issues we're going to be watching so carefully. We're going to be following the polling. Certainly keeping an eye on that. I want to know how the bond market's going to trade today. How is are we going to continue to see the sell-off? Is that going to be a story that we're going to have to continue to factor in?
We are in Europe so far.
Precisely.
Yeah, so European bond markets, we see moves of 2-3 basis points, so not huge, but continuing that theme. And, you know, London opened in the last hour since we last checked in, and that one also seeing movement to the upside.
PMI is coming up later on this week. That's going to maybe further confirm what we're seeing in Europe, the weakness that we're anticipating there. Is this an inflation? I don't think we've fully got the answer to the question yet. Is this a Trump trade? Is this an inflation trade? Is it a deficit trade? What is going on here? We don't know. And I still don't know what the trigger was yesterday to certainly push us higher in terms of the yields that we're watching. But it's going to have an impact if it continues.
You made a key point about the supply story as well and the issuance story. We should also point out that even though so many of our investors who've joined us around this table have talked about bracing for volatility in the bond markets, bracing for some sort of freak out, you are still seeing a lot of liquidity in this bond market. They can digest it. They can really cushion some of those jitters. That's going to be certainly something that we're going to keep an eye on, but it may not be the cracks that we saw maybe even just 12 months ago. That does it for the opening trade. The pulse is up next. Mixed picture in Europe. Stick with us. This is Bloomberg.
everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close, weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Newsmakers and market movers. This is The Pulse with Francine Lacroix.
Good morning and welcome to The Pulse. I'm Tom McKenzie at the Bloomberg Tech Summit here in central London. Here are today's top stories. European stocks are mixed, with bonds extending a global sell-off. That's as traders weigh a slower pace of US interest rate cuts. Secretary of State Antony Blinken makes an 11th visit to the Middle East as the US renews its push for a ceasefire between Israel and Iran-backed militants. Shares in SAP jumped the most since July as cloud revenue soars at Europe's biggest software company. And we're going to be speaking to the CEO of another European tech giant shortly as we hear from Christophe Fouquet, the CEO of ASML. Let's check in on the markets then. Yes, a reassessment in terms of the Fed's next steps leading to that global bond sell-off. We saw a marked jump in yields yesterday across US Treasuries. Here's the read across then, across your equities space. US futures currently pointing lower by 0.2% after modest losses yesterday. NASDAQ 100 futures pointing to a drop of 50 points at this moment. European stocks currently off by 0.2% across the European Stock 600, the benchmark, of course. On your yield space then, at the front end, the US two-year Treasury currently yielding you 4.04 with a move of just 1 basis point in the session today. 150.96 currently on the Japanese yen. We've seen some softness in the Japanese currency, down about 5% in the last 30 days or so, as we build up to that election and vote out of Japan over the weekend. Brent trading at 73.88, down 0.5% in the session. Gold up again so far in the session, up 0.5%. Another positive day for the yellow metal, trading at 2,733 per troy ounce. Now, Wall Street veteran Ed Yardeni says the best election outcome for US equities would be an impasse that leaves neither party with a dominant position. He also spoke on the Treasury market, calling for US 10-year yields to rise to 4.5%, but he says they could reach 5% if either party wins a sweeping victory.
I think if we do get a sweep by the Democrats or the Republicans, it almost doesn't matter. Either way, we're going to have wider deficits more debt accumulating, and possibly inflationary consequences.
Okay, for more, let's bring in Bloomberg's Valerie Teitel to get assessment of how the markets are digesting these evolving views on the bond market. Valerie, is it a worry then over deficits driving the Treasury market, or the commentary we've been hearing from FOMC officials?
Look, Tom, it was very interesting to hear from Ed Yardeni just there in that video talking. It doesn't matter who wins the election. If it's a sweep either way, the deficit is going to grow, and he sees 10-year yields. They could reach 5% if we do get a sweep by either party. It was a bruising session for the bond market yesterday, but even today we are still ticking higher in yield. We're now up over 12 basis points in the 10-year sector, but a lot of questions over what drive this. Is it the Trump trade? Is it the Fed speakers we heard yesterday? Is it this worry about deficits? If you change on to my next chart, I just want to show you how this Trump trade has evolved over the last few weeks since the end of September. This blue line here is the betting odds of a Trump win. You can see as they have grinded higher, predicting more of a chance of a Trump win, we are seeing a stronger dollar, and we're seeing those U.S. yields head higher. So perhaps it's the Trump trade leading the markets at the moment. We're now 14 days away from that U.S. election.
Yeah, indeed, the countdown is on, isn't it? The Trump trade seeming to overshadow the views coming through from some of these FOMC officials, as you say. How has the Fed pricing adjusted then? We have the likes of Apollo coming up, Torsten Stock saying, you know, maybe the Fed just pauses in November. How is that kind of expectation being built into market views?
Yeah, it was interesting to hear from Apollo's Torsten Stock talking about a November pause. But if you look at the pricing of what's going on in the market, we are still easing and taking out all these expectations for a Fed cut. It was only just a few weeks ago we were pricing in 2 back-to-back 25 basis point rate reductions from the Fed. But as you see here, we're now pricing in only 40 basis points of cuts throughout year end, 22 basis points for this meeting in November, and only 17 basis points for that meeting in December. The expectation is, as we continue to get this hot string of U.S. data, perhaps the Fed doesn't need to cut as aggressively.
Okay, so if November is not in the balance, then December certainly is. Bloomberg's Valerie Teitel with a breakdown across these markets and how things are being adjusted around Fed expectations. Valerie, thank you. To the corporate conversation, the earnings story right now. S&P, SAP getting a boost in the session today and helping to lift the DAX into positive territory. You can see the SAP, that stock jumping more than 5% on the back of the earnings story, of course, out of the third quarter. That came in roughly in terms of the cloud revenue for SAP, now the biggest software maker by market cap in Europe. SAP's Q3 revenues coming in an increase of 25%. The other tailwinds for SAP then are the fact that they have these forward view, 12 months into the future in terms of commitments around bookings, and that saw an increase of 25% as well. Interestingly, SAP also raised their outlook for cash coming through in terms of the longer term for the year, up to 4 billion euros on that front as well. Cloud revenues, by the way, they're guiding that up to around 27% at the high end in terms of cloud revenues. The CEO saying yesterday that about 30% of the demand coming through in the third quarter from their customers did have that AI link. So customers wanting some of those AI analytics and services that SAP provides. And the CFO telling me today he sees that gradually improving as well in the months and quarters ahead. Interestingly, this is a company that's seen its market cap increase by about 100 billion euros year to date, and that is proving some problems in terms of its market weight on the DAX. They're bumping up against that 15% limit and that cap that's imposed by German authorities, and the CFO telling me he'd quite like to see that removed. The stock up more than 50% now year to date. SAP then with that look and outlook in terms of the demand coming through with cloud services as they push further into the subscription model from the licensing model, and that is starting to pay off as well. We're going to hear as well from some of that conversation with the CFO of SAP. I was speaking to him earlier. Take a listen.
We would like to see that kind of 15% cap disappear because it constrains a little bit the demand in Germany. But we are really focusing on the large pools of capital available in the United States. There's still a lot of runway, a lot of room for us to grow and attract new investors. We would like not to exit Germany, but to the contrary, attract capital into Germany. And on that front, I have to agree the 15% cap in the DAX is not very helpful.
Okay, the CFO of SAP speaking to me earlier saying, look, he wants to attract more capital into the German markets. He's not considering delisting and listing in the US, for example, wants to continue to attract that capital into Germany, but wants to see that cap removed, or at the very least, adjusted, as the market cap of that company is plus 260 billion euros right now. Let's stay on the tech space and pivot to the conversation, the news out of Qualcomm, of course, the chip maker, so essential, particularly to those non-Apple iPhones. And the news reported from Bloomberg that they are developing and have unveiled a new smartphone chip. This is an adjustment to its own designs. Pre-market, the stock just off 0.3%. We'll see how that changes through the session. But again, an update and a reminder of the fact that Qualcomm is trying, at least on some measures, to be less dependent on the kind of architecture and designs from ARM. And we're going to be hearing from the ARM CEO, René Haas, later in the day from the Bloomberg Technology Summit. Let's bring you up to speed on some other stories making news so far this Tuesday. China is on track to become the largest market for Russia's pipeline gas this year. That's after Europe cut imports following the invasion of Ukraine. Bloomberg calculations indicate Russia exported 23 billion cubic meters of natural gas to China in the first 9 months of 2024. That's nearly 40% more than a year ago. The UK, meanwhile, is to loan Ukraine £2.3 billion to purchase military equipment paid for by profits generated by frozen Russian assets. The funding comes as part of a wider $50 billion package from G7 nations and the EU announced back in June. G7 allies have collectively frozen about $280 billion of Russian central bank assets, with the majority in Europe. Italy's government has passed a new law to overcome a court ruling that blocked the Prime Minister's plan to send asylum seekers to Albania. 12 migrants were returned last week after a court said they originated from countries that could not be recognised as safe. Italy's cabinet has now approved a list of 19 so-called safe countries to allow the plan to continue. And the new CEO of Prosus says adjusted profit at its e-commerce division is expected to surge more than 950% this fiscal year. Fabrizio Bloisi told Bloomberg he's deploying artificial intelligence across the business as he reshapes a complicated business legacy. We're going to hear more from him later on in the show. But let's cross over right now. Let's bring you that conversation live with the CEO of ASML, Christophe Fouquet, speaking to Bloomberg's Tom Giles. We can listen in now after that surprise cut to the outlook from ASML.
Around the world. But last week you had to do some expectation resetting in terms of bookings, in terms of your outlook for 2025, and how long the chip recovery will extend. You said on the call today, without AI, the market would be very sad, if you ask me. That definitely spread some sadness in the market, in the stock price. Could you give us a sense, when you talked about the new expectations, you focused on a couple of things, some of your customers like Samsung and Intel, but also China. And so I'm wondering if you could give us a sense of, on balance, how much of your resetting of expectations was related to changes in China versus weakness in some of the large customers that I mentioned?
Yeah, so I think last week we said a few things. And I think the first thing we said was that we still see AI as a huge opportunity for the industry. And we still see even upside on the short term. So I think AI has been with us now for a couple of years. It's created a lot of excitement. And like all our peers in the industry, I do believe that AI will bring a tremendous opportunity for this industry. So that's the first thing we have said. So I said on the long term, AI is going to build up a real strong opportunity for the industry. Now, on the short term, I think you're aware of that. Not everyone is surfing yet on the AI wave. I think some
we'll move from supervised full self-driving to unsupervised full self-driving, where the car, you could fall asleep and wake up at your destination. So, but there's also a challenge for a lot of people that cars cost too much. I mean, when you factor in everything that goes into a car and the car insurance and the car payments and the storage of the car, it's very expensive. So with, and you said like how often how many hours a week are cars used? Your average passenger car is only used about 10 hours a week out of 168 hours. So the vast majority of the time, cars are just doing nothing. But if they're autonomous, they could be used, I don't know, 5 times more, maybe 10 times more. So you could actually, for the same car, would have 5 times as much value, maybe 10 times as much value. There's 168 hours in the week, and like I said, only 10 of them are used for driving. So, and then a bunch of those hours are looking for a parking spot, which is, can be pretty annoying at times. So we want, with autonomy, you get your time back. This is a very big deal. So it's not just it'll save lives, like a lot of lives, and prevent injuries. I think we'll see autonomous cars become 10 times safer than a human. I mean, if you think of times past where there used to be an elevator operator in every elevator, but once in a while they get tired and accidentally shear somebody in half, So now we have automated elevators. You just get in an elevator and you press a button, and you don't even think about it, and it just takes you to the floor. And if you did see an elevator operator with a big relay switch, you'd be like, "That's weird." Now that's how cars will be. And it's not just the lives saved in injuries, but if you think about the cumulative time that people spend in a car and the time that they will get back, that they can now spend, well, I guess on their phones or watching a movie or doing work or whatever you want to do. You can think of the car in an autonomous world as being like just a little lounge. You're just sitting in a comfortable little lounge, and you can do whatever you want while you're in this comfortable little lounge. And when you get out, you will be at your destination. So, yeah, it's going to be awesome. So,
what Chinese manufacturers can buy given export controls?
Yeah, so maybe first a step back. If you look at China, we just talked about AI. AI is the very advanced semiconductor manufacturing, very advanced chips. China, for a few years now, is focusing on what we call mainstream semiconductor. So semiconductor, we used to talk about IoT, all those chips that you have in all the product, making those products smarter. That's the type of chips China is basically manufacturing today. One part of the reason for that is, of course, the restriction that have been applied on EUV, as you know, which have prevented China to move to very advanced node. So the focus of China is on mainstream semiconductor. Right. The demand for that has boomed in 2021-22. As a result, the demand we had in China in 2021-22 has boomed as well. And 21-22 was the time, if you recall, where the demand was extremely high and ASML was struggling to deliver tools to everyone. Therefore, we couldn't deliver a large part of the demand in China. Backlog in China grew. 2023, the rest of the market softened. We got tools we could ship to China. Same in 2024. So the level of business we had with China in 23-24 was more of a result of the non-deliver capacity in 22-21 than anything else. And we have always explained that, our quarter at 50% of the business in China, almost 50%, this was not normal. This was a peak resulting from basically a lack of delivery before.
Right.
The normal business in China is around 20-25%. Right. And that's the normal demand related to mainstream semiconductor. And I think we're going to go back to those numbers over time.
But there is something artificial about the way we think about China as a purchaser of equipment like ASML's, in the sense that many countries around the world, U.S. principally, have been exerting export controls on the country. are those controls going to become even more stringent? For example, China is not able to buy your most advanced machines. Is it possible that those restrictions could extend to the DUV level, which is used for more mainstream products?
Yeah, so if you go back to the root cause, or I would say the prime motivation of export control, it was to prevent China to have access to advanced technology. EUV is not in China. By not having EUV in China, we pretty much stop the ability of China to go beyond the 5, maybe 3 nanometer node. They may be able to do a few chips. You may see some of that in the press because, of course, everyone is watching very carefully. But fundamentally, by not having EUV, we have placed China, the regulation have placed China, I would say 10 to 15 years behind when it comes to advanced technology. We always talk about China. We usually forget to mention the fact that while those restrictions have applied on China on EUV, a lot of work has been done with other players in the industry, Intel, TSMC, Samsung, on the most advanced EUV technology, as we know it today, High-NA, et cetera, et cetera. So there's been a lot of work done every single day to continue to widen, if you want, this technology gap. And EUV is a key element to be able to do advanced technology. Right. You know, I think Intel has proven to the world a few years ago that without EUV, life was getting impossible. That's also true for China. So this limits part of the activity there.
Based on your interaction with the Prime Minister of the Netherlands, with the Foreign Ministry, is it your expectation that the restrictions will become even more limiting on China's ability to purchase machinery like ASMLs?
Well, if you look at the geopolitical landscape, I think it's clear that the United States will continue to apply pressure on their ally for more restriction. Now the discussion we have with the Dutch Prime Minister, with, I would say, the European political leader, because at the end of the day, we are a European technology champion company, right? So yes, these are the people we have this discussion with. And the question is, what is right for the Netherlands? What is right for Europe? And as a result, what is right for ASML? So what restriction makes sense when it comes to national security, which has been the prime argument, and where does it stop, right? Because like I say, a lot of the focus in China today is on mainstream semiconductor. And this is very different from, AI. So that's the discussion we have. I think the pressure will continue to be there because, if you look at the landscape, that's what it is. But I think that the discussion will get more sophisticated over time. The stake will become higher. And I think that countries like the Netherlands, all of Europe, where again we belong to, will also more and more start to discuss what makes sense for us.
Does it make sense for the European Union to work in such close concert with the U.S. in making it difficult for China to get access to these machines? At what stage, and do you find yourself wishing that the Dutch government and maybe the EU government would push back harder on some of the restrictions that the U.S. would like you to impose?
Well, I think, as a European citizen, right, Dutch, I would say resident, not citizen, as you know, I like to know that they do what is right for Europe and for the Netherlands. I think that's the most important things. We're not a politician. I don't know half of what they know, of course. And there may be good reason to restrict. And if there is a good reason to do so, and our government believes that, then we will go with it, of course. I think what's very important is to have the discussion with them so that they understand what we do, maybe understand the industry a bit better, and they are better equipped to really decide what is good, again, overall for European countries and for the Netherlands.
Based on your interaction with your customers in China and globally, is it your perception that the motivations for export controls are truly about national security interests and regional security interests versus economic competition? In other words, how much do you think this is about keeping China from becoming economically more competitive with the rest of the world versus these are legitimate security threats?
Yeah, so Tom, I could almost turn you back the question, right? You almost have a rhetoric question, I think, in here. And what you see happening is more and more people are asking themselves this exact question. And if you look at the press, I think there is a real debate happening. That's one of the debate. Is it really about national security? We know that there is, of course, a strong economic competition between, the US, Europe, China. We see it everywhere. People question how much of that has a play in the decision. The other debate you start to see, which I think is also related, is does it help us or does it hurt us? I think there's a lot of companies in the US that start to also question, is that a good thing for us? And I think that's the key debate to have, because, like I said, I think at the end of the day, we need our governments to do the right thing for their people. And I think those debates are far more, active, far more lively than they were 2 years ago. And I think it's very good. I think it's very good because most probably this brings us to what I will call a more rational discussion and a more balanced set of decisions moving forward. So I think we can only welcome debate in such complicated issues.
Thank you. I want to talk a little bit more. Let's bring things a little bit more local to the Netherlands, where ASML has discussed with the Dutch cabinet it wants to operate successfully in the country. Your predecessor, Wennick, said, if the Netherlands shuts down and we cannot get immigrants or foreign students, then fine, you should accept the consequences. Now, the Dutch government, to its credit, has set up a task force, said it will spend billions of euros in the Eindhoven region to keep ASML at home. My question is that enough, particularly in a world where there is a coalition led by a far-right lawmaker that's looking to implement the strictest ever anti-immigration policies? The cabinet's working on areas to restrict labor migration. You are dependent on labor from not just domestic, but around the world. How concerned are you about the forces at work bringing this anti-immigrant rhetoric and policy to the Dutch government?
Yeah, so here also maybe if you take a bit of a step back, I think that this is almost an issue for Europe, what you describe. It's happening in the Netherlands, it's happening in many countries as we speak.
It's happening in the US.
It's happening in the US. And what we try to do, again, in our discussion with our government, every government wants to have company like ASML in Europe, in the Netherlands, right? Everyone wants that. The more, the better. But to be able to have company like this, you need a few things. You need to have access to capital, access to people, access to energy. You need to have a place to build your factory. All those conditions have to be there. And if you want to compete with other countries, China, the US, whatever, not only you need to have those conditions, but those conditions have to be as good as possible so that you can be competitive. Because this industry is extremely competitive. And no one should ever take any success for granted, right? Of course, the story of ASML is great, but it's only great after 40 years of very hard work, and this is, something you have to preserve. So we need all those conditions to be there. I think, the Draghi report was also a good way to summarize what the entire industry in Europe think. And our governments have to work on that. And, of course, there's a bit of, immigration is a bit of a topic of the day because that's a way to get people attention. And I think what we have said is we have built our company with more than 100 nationalities. So bringing talents from everywhere has been an absolute condition for success, and this has to continue. Now, the good news is, as you said, I think people are listening.
Okay.
And maybe when you get down to business, people are more reasonable than maybe when they run a campaign or try to get elected.
Does it make sense for ASML to consider locating or relocating some operations outside of the Netherlands as at least a contingency measure to ensure that you have access to those ingredients that you mentioned that over 40 years have made ASML a great company?
So the threshold to do that is pretty high for us because we are developing extremely sophisticated machines. Technology, in fact, is a combination of many, many technologies that we have to bring together. Our supply chain is 80% of it around the Netherlands, Germany, Netherlands, France, Italy, very close. Our R&D is now, of course, almost fully in the Netherlands. We have R&D center also in the US, but I would say the large part of it is in the Netherlands. And one very important thing, because of the complexity of our tools, we want to keep our research development very close to our manufacturing center. Because what you may not realize is every 2 years we make a new step on our machines, so we have to improve them every couple of years like our customer. And it's meant that every 2 years we build new machine. And we have to teach our manufacturing people very quickly to be able to build those new machines. So there's been a long-lasting principle in ASML that we want to keep R&D and manufacturing together. And we'd like to do that in the Netherlands because this is where we are. So the threshold to change that, I think, is very high. And I would say new things like geopolitics give us even more reason to stay in the Netherlands so that we can build this very strong relationship with the Dutch government, with the European countries around us to also get the support of those governments in our activity.
So it's not really being considered now to maybe locate some operations elsewhere?
We have operation elsewhere.
Further.
But we will only grow those operations based on the activity we have in the different countries. But we don't at all consider to move a large part of our operation outside of the Netherlands. Not at all.
European Union has a tens of billions of dollars plan to expand local manufacturing capacity with the goal of doubling output from the region to 20% of the global market by 2030. In your estimation, is this a realistic expectation? And what are some of the hurdles that the region needs to overcome? This is the idea of increasing the region's capacity to be a bigger producer of chips to the global market.
Yeah, so I think it's very simple. If you want to achieve this kind of target, you have to build capacity. If we look at, for example, where we ship our system today, most of our system, 80% of our system, are still being shipped to Asia. So Asia remains, at least for quite a few years, I would say the key manufacturing place for semiconductor. To get to 30% share of the output, you have to take more than 30% of the tools that are going to be shipped. We don't see that yet, so I think that most probably the progress is not as fast as some people hope. I think you have also heard, of course, some major delay, right, in some of the factory in the US. So this is pointing to most probably a slower execution. But, you know, you only can start to believe the target will be achieved when the capacity build is exceeding 30% of the total worldwide capacity, which is not the case yet.
In our introduction, Caroline reminded us that we have an election in the U.S. in a couple of weeks. You might have heard about it. It's very close so far in the polls, but would you expect conditions for the global chip-making world to become better under one candidate versus the other in the U.S.?
Well, you know, there's a lot of, of course, like everyone else, you know, I follow the election in the US, and you can see a lot of polarization, I think, in the debates. There's one topic that still is, I would say, shared by both sides in the US. It's China. That's one, I think, one element of agreement. So we don't expect major changes there. We expect the pressure on export control on China to remain. To tell you exactly how this will play out, I really don't know, to be honest. I think
do you think it'll be ratcheted up? Do you think that pressure will be, you talked about it's going to remain. Do you expect it to be ratcheted up?
I think, I told you the pressure will be there. After, I don't know, it's speculation if, one candidate may want to do more than the other. I don't know. But like I said, that most probably will not come without a debate. And I think that, this is what we've seen happening now for a few months, but we'll see.
At Bloomberg Tech, we like to talk about new products. You've got a new one coming out, high NA EUV. We showed an image of it earlier, $380 million. One of our sizes and scopes, it's the size of a bus or a size of a small Amsterdam flat. Some of ASML's customers have raised concerns about the price tag. One SVP at a major customer said, I like the high NA EUV's capability. I don't like the sticker price. Are you concerned that the price tag could affect demand for it? And I'm asking this as someone who has about 100% market share in this, so I understand.
Yeah. No, so, I had the question many times in the last few months, and I always gave the simple answer. We never build a product in ASML with the idea that the new product would be more expensive than the previous one. Of course, the price is higher, but the price of all our product has been higher over time. And the reason for that is that the value they bring is even higher. So I think the reason why we make INA is basically to enable customer to look at new design, so to create more flexibility, to look at the ability to go down another 2, 3, 4 nodes, which for this industry, at the end of the day, is the highest value we can ever generate. Someone, a customer told me, AI can happen today because we have this 3 nanometer node. We couldn't do AI with the previous node because this would have been too expensive, this would have been too much energy consumption. And in fact, for AI to really span out in all applications like we all dream of, there'll be a need of another 2, 3 nodes to make sure that the cost goes down, to make sure that the energy consumption goes down. INA is going to contribute to that. What we dream of in ASML for the next 5, 10 years is going to contribute to that. And the value of INA is to continue to enable Moore's law to go with, of course, nowadays a bunch of other technology. But this is huge value. I was also discussing with Caroline, who say, AI is coming, it came, it's a big bang, right? And we know that as long as we continue to drive the industry, there will be another big bang at some point, which no one can even start to dream of. But this has been the story of this industry, and this is what INA is going to contribute to, right? So customer will adopt INA when the value of it is right, and they will continue to use all the other lithography product, of course, at the same time.
My last question for you before I let you go. We saw during the pandemic what can happen when we lose control over the supply chain. Do you feel like it would be necessary for ASML to somehow use its cash pile to do more to gain control over the supply chain, have a little bit more power in decision making, whether that would be making acquisitions or increasing the stake in one of your suppliers such as Zeiss?
Yeah, so it's a very good question, by the way, because we said the market is going to be a bit less than we expected in 25. At the same time, we are continuing to build the capability we were missing in 2022. So that part, ASML has not stopped because it takes time to do that. And we have, of course, had those discussions with our suppliers. Most of our suppliers are partners. Zeiss is a true partner. They understand our industry how much as we do. We call the relationship with Zeiss 2 company, 1 business. I mean, the business is the same, and we still have a bit our different ways to do things. What I'm trying to say is that for most of our suppliers, we have a very strong alignment to make sure that we can meet the supply challenge of the industry. Only in very rare exception, we are acquiring some of the suppliers. The reason for that is usually if they cannot scale fast enough, if they cannot invest to the level we need them to invest. I think Cymer was a good example of that. When Cymer had to develop EUV, this was just too much too quickly. Therefore, we brought them in. We have another few examples, but that's the exception. We try to keep the supply chain separated because this allows us, if they deliver as we need, to be a lot more agile on our product and with our customers. So the model is very powerful, we believe.
Christophe, thanks for being with us today. Please join me in thanking ASML CEO Christophe Fouquet. Thanks so much.
Okay, Christophe Fouquet, the CEO of ASML, speaking to Bloomberg's senior executive editor for global technology, Tom Giles, here at the Bloomberg Technology Summit in central London, talking again, reiterating his views on the huge opportunity he describes around artificial intelligence, but really interesting on China and expectations that whoever is in the White House come January of 2025, the pressure for additional restrictions on China is likely to increase. That's the view from the CEO of ASML. Also talking about meeting that backlog that had built up from orders of 2021, 2022 from China and how that made them and pushed up the revenue stream, the sales into 2023. That is starting to slow now. And again, pointing to the softness in the demand for customers that produce chips for the auto sector, PCs and industrials. Coming up, an upbeat market outlook from JP Morgan Asset Management. The company's head of global multi-asset strategy joins Guy Johnson to discuss why they're so bullish about 2025. That is next. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching The Close. Welcome to Balance of Power.
This is Bloomberg. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Welcome back. You're watching The Pulse. I'm Guy Johnson. Before the break, Tom McKenzie was talking about the AI trade. We'll be back there
in just a moment. Let me assure you of that. But let's talk about the bigger picture and how that AI story folds into the wider narrative. JP Morgan Asset Management has published an optimistic outlook for its long-term capital markets predictions. It does this every year. It's, I think, the 29th report that we've seen out of JP Morgan on this subject. This is the report for 2025. It talks about a strong and even buoyant economy, global economy that's going to emerge. This as investment levels pick up and rates start to normalize. One of the authors that puts this together is John Bilton, JP Morgan Asset Management's head of global multi-asset strategy, and he's sitting around the table with me this morning. Nice to see you.
Yeah, morning.
So I think I talked to you this time last year about this, the 28th one. Let's talk about the 29th version of this. What's changed?
Well, I mean, if we took just the raw moves we've seen in markets this year, I mean, over 20% rally in the S&P, you'd expect the outlook would be a lot more dour. We'll have taken a lot of the returns from the future.
Yeah, that's Scottish for bad, by the way.
That's Scottish for bad, it is.
Yeah.
But the point being that if we actually look today, we still see a pretty optimistic outlook because we've gone through with a fine-tooth comb. We've looked at where investment's happening from governments. We look at spending patterns. We look at AI and technology, which is just beginning to embed in the supply side of the economy. And actually that pushes up the earnings base and the growth base to a level that's, for the G7, the highest level in nominal growth terms that we've forecasted now since 2020. So fifth annual upgrade running to our growth expectations. And certainly seeing the way growth is getting delivered around the globe and especially in the US, that gives us confidence that there's still growth into these valuations that we've seen expand this year.
In the last year, the noise has been epic. The swings have been absolutely gargantuan. How can you see the signal in that noise?
Well, I mean, this is just the very point. We've got a market which is trying to calibrate to a new economic era. You know, we've gone past that new normal phase, that ultra-low interest rate phase, where really central bank activity goosed up asset markets, to one where we're actually seeing more investment in future productivity, both from fiscal spending from governments, talked about in the US, talked about here, even across the Eurozone with the Next Gen Fund. We're seeing more normal interest rates. We're seeing real interest rates that we expect to be positive. And that's beginning to build sort of growth rather than simply inflating asset prices. So actually having a focus on that as the market is trying to calibrate that shift from the old to this new world, we think is really, really important to do.
In terms of what that is going to mean, is it going to mean higher interest rates? Because there's another way of looking at investment, which is deficits.
Yeah.
Okay. Bigger deficits. Generally, the bond market doesn't like bigger deficits. Generally, the bond market prices higher yields, particularly at the kind of the longer end down the curve. Is that the kind of the scenario we're looking at here? Yes, we're going to be investing, but the cost of that is going to be a higher cost of money.
Well, you can try and come at the debt to GDP equation in one of two ways. You can either try and shrink the numerator, or you can grow the denominator.
Yep.
We spent a decade trying to shrink the numerator, and it didn't end well.
No.
You know, all we ended up with was rates below zero, real interest rates in the US at negative 1.5% throughout the period from the financial crisis to the pandemic. We're projecting around a positive rate of around 70 to 80 basis points going forward in real Fed funds. And that's more of a normalisation. And we're expecting that that's justified because the economy is stronger as we're seeing more fiscal involvement. We're seeing less need for central banks to do all the heavy lifting. And that's a healthier outlook. Typically, healthy economies should have neutral or positive interest rates, not deeply negative ones as we saw in the last decade or so.
So what am I going to get out of my 60-40? And is it going to be more than I'm getting out of my money market account?
Oh, yes. Oh, yes. Well, make no mistake about that. We're expecting out of cash, US dollar terms, 3.1% on average for the next decade. Sounds pretty good, but it's a long way down from the 5% today. A lot of reinvestment risk. 60-40, we think we get about 6.4% with a Sharpe ratio of about 0.3, 0.31. So for investing, actually, although it's come down from where it was a couple of years ago after we'd seen the sell-off in 2022, we're still looking at something which is smack bang in line with the last 25 years average from a global stock bond 60-40 in dollar terms.
If I want to juice that, how do I do it?
It's all about the alternatives markets. You know, 2 years ago, we saw that big reset in bond markets and stock markets. It was painful. Past couple of years, we've seen real assets remarked in private markets, real estate, etc. If you add in, you know, an exposure to private equity, infrastructure, real estate and transportation, you take about 30% of your 60-40 and allocate it across there, you can push up that Sharpe ratio by a third to about 0.43, and you can boost your returns by about 80 basis points. And remember, our numbers are just for median manager. That's before you've started to layer in manager selection alpha.
Over at Goldman Sachs, David Costin's pretty convinced that the S&P is done. You're going to get a little bit of a boost now. maybe to the back end of this year, but then over the next 10 years, you're not going to get very much out of the S&P. It's basically priced in all of what you talked about already, and the asset price inflation is already in the market effectively, is what he's signaling. You want to take the other side of that trade?
We certainly do. I mean, David's a great guy. We love the work that they do. But at the end of the day, we see more positivity. You know, the expectation that the US economy is not going to be the globe's dominant economy, and that we're not going to see the S&P 500, which has huge innovation, very strong revenue capture, and a very, very dynamic capital market behind it, and is designed for a digital economy, which is what's emerging today. How that doesn't capture the lion's share of returns, we struggle to see. Yes, you don't have the valuation support that markets like Europe, UK, Japan have today, but you certainly have huge reinvestment and huge upside in terms of returns. So we see about 6.7% expected return from S&P 500 over the next decade or so. And we think that actually when we look at that in volatility adjusted terms, it's still very much the core of the portfolio.
In 2 weeks' time, we've got an election in the United States. It's going to have a big impact over a significant chunk of your forecasting window, next 4 years. How big an impact could this election have on what you see in terms of what the outcome is going to look halfway through the 10-year kind of window you're looking at?
Well, when I think about it over our long term, we've got 3 elections that are going to be pretty significant over our forecast horizon, which is 10 to 15 years. But yes, of course, this one's going to be very important, as they always are. But the thing I would also note is if I look at cash returns versus a 60-40, following any geopolitical shock over the last 35 years, over 1 year horizon, 60-40 beats cash by an average of 8%, 3/4 of the time. Over 3 years, it beats it by an average of 19%, 100% of the time. So we've seen this movie before. Geopolitics is a fact of life, and we have to work through it. But ultimately, we're looking at a strong economy in the US, a catch-up play that we can see taking place in terms of government spending, strong private sector spending, and we think a much improved supply side to the global economy over the decade ahead.
John, it's always a pleasure working through this with you. Thank you very much indeed for bringing it to us. John Bilson, JP Morgan Asset Management's head of global multi-asset strategy. Coming up, more pressure on the European auto sector. Car sales falling in September, their first consecutive monthly decline in more than 2 years. The details are set to follow. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Green World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back. Happy Tuesday. I'm Tom McKenzie at the Bloomberg Technology Summit here in central London. To the auto sector now. New car registrations in Europe fell more than 4% in September. That's compared to a year ago. At Stellantis, the owner, of course, of brands including Fiat and Peugeot, sales dropped 26% across the region. Let's bring in Bloomberg's global autos editor, Craig Trudell, for the details. Craig, were you surprised by this drop in sales?
Not necessarily. I think we've seen just in the last couple of months some softness for the European market. If there was a surprise here, it's that maybe that we've actually seen the battery electric vehicle sales trending in the wrong direction, and that being a big source of concern. And what we saw this past month was actually some firmness on that side of the market. Sales were up about 14%, which is a positive development for the car makers making this transition. But it was really the weakness on other sides of the ledger that led to this first back-to-back decline in monthly sales since mid-2022.
Yeah, and particularly the numbers for Stellantis, as we mentioned, they were ugly indeed. But as you say, silver lining maybe when it comes to electric vehicle sales. This all in the run-up to a big earnings week in the auto sector. Craig, what are you and the team going to be looking for?
Yeah, I think today General Motors will sort of kick things off. I think there's unlikely to be much in the way of surprise out of GM in that they just had an investor day and sort of signaled sort of what to look out for. I think this is largely a U.S.-driven story, and their pricing in that market has been extremely strong, and that will probably be a major point of emphasis. I think you mentioned Stellantis, concern about whether or not the fact that that company is going to have to sort of bend on pricing and discount in order to clear inventory, how disruptive that is for other automakers that report this week. Tesla, of course, tomorrow as well will be interesting, just in that we have seen some softness for their sales. They had some improvement in the latest quarter, but I think one of the things that I'll be looking out most for from them is actually regulatory credits. So they sell credits to other automakers to help them comply with CO2 standards. That business is actually proving to have some real staying power as other automakers struggle with selling more EVs.
Okay, that's really interesting, Craig, on the regulatory credits for Tesla, what to scrutinize out of those earnings. Our Global Autos editor, Craig Trudell. Craig, thank you. Later today, we're going to have a conversation with the director of DeepMind, John Jumper, and the CEO of ARM, Rene Haas, as part of the Bloomberg Tech Conference that continues here in central London. Stay with us. This is Bloomberg.
race down to the 18 to 35-year-old market. How do we bring these kids, these influencers, this new generation of people interested in the game of golf? There's 738 million people in the world who are interested in the game of golf. Don't play the game of golf, but interested. There's about 60 million golfers. So we have another 670-odd million people we can go figure out how to get them interested, not just in live, but in the game of golf. And so we sit down and you talk about this internally with your production team, you talk about with your marketing people. When you look at our audience base today, that we have like about just around 50% of our ticket sales are 45 years and old and younger. Following the PGA Tour, it's the oldest aging demographic in sport. It's 67 and a half. So in a matter of a year and a half, basically, we've pulled that 67 and a half down to 45 because of our product, because of the entertainment side. There are places around the world where 32% of our ticket sales are women. So they're coming to an event that they feel inclusive with. Right? So all of a sudden, we're seeing these data points coming out going, my gosh, why haven't, we're owning this space.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Good morning from our global headquarters in New York. I'm Manus Granny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's start that agenda.
A global bond rout as markets question the Fed's path and fiscal risks. Simpler, more dynamic, and agile, HSBC launches its biggest restructuring in a decade. And as global conflicts rise, defense company Saab order book surge. CEO Mikael Johansson joins us later this hour. Good morning, Manus.
Danny, good morning. The line of the day goes to Kit Jukes at SocGen. There's blood on the bond floor, and that is the very representation that you're seeing here. 10-year government bond yields spiked by 11 basis points in total yesterday in the U.S. What is the driving force here? Because this spooking of the U.S. bond market caused a pretty significant global carnage. Is it that the Fed may need to pause? That's what Torsten Slok has said. He talks about the 10 tailwinds of the U.S. Ed Yardeni, still beating that sell bonds, buy gold. And then we've got the Fed speak, and we can debate that in just a moment. Either ways, the propulsion in the bond market is higher. People now talk about 4.5 as being very realistic, if not that 5%. Roll it over and have a look at the bond market because, again, there's a potential headwind as we see higher rates. And we saw a little bit of slippage in the equity market yesterday. Although, irony of irony, NVIDIA managed to make a new record high. So again, it's about unpacking these headwinds that may build up for the equity market. There's NVIDIA down by 0.5%. It's, reminiscent. Murder on the dance floor, blood on the bond
floor. Were you about to sing? You were
I'm
so
not
close.
singing. I was so close.
I could feel it, Manus. Okay, so again, this is about fiscal, it's about monetary policy, It's about Manus singing. I think it's interesting to debate. If this was about the Trump trade yesterday, is this a teaser for what it may look like after the election? Should there be a red sweep? And does that mean it's bad for stocks? Small caps were hammered yesterday. Under a Trump trade, that's supposed to be good for small caps.
Well, if you take the playbook from 2016, there's a very initial sort of momentum in these markets, in the bond markets. Yields are up 50 basis points so far into this election, as opposed to when Donald Trump acceded to power, which was the momentum higher in yields. So to a certain extent, this bond market is beginning to front run and price in a Trump victory.
Well, also back then, inflation was low and the Fed would have welcomed more inflation and been okay with it. This time, it's a different Fed, Manus, which might feel the need to pause, or as Adam Posen of the Peterson Institute says, maybe even hike next year, should there be Trump policies unleashed onto this market. Anyway, it is a global bond market sell-off. You noted this, Manus. Let's just quickly whip through it. You showed us the 10-year yield. There you go, up 12 basis points over the past 2 days. Look at what BTPs did. Italy also seeing moves of 15 basis points yesterday. Germany was 10. Let's get over to Seamus Murphy, Managing Director at Cargill Hill Capital, an independent research provider focusing on financial systems and select equities. Seamus, thanks so much for joining us this morning. Can I just get your take on yesterday's big move in yields?
Yeah, I suppose really from our perspective, the movement in yields is really reflective of excess fiscal policy that's been going on globally. So I suppose really for us, it's no real surprise. What's actually happening is this concept. We think what's happening is this concept of crowding out, whereby because we're running these large excess fiscal deficits, then the private sector just kind of cannot participate to the same extent. So you look at the UK running 150 billion, 200 billion deficit every year. So therefore the private sector can't participate. So therefore we're not getting any loan growth. And so therefore it's actually perfectly normal that we would expect a steepening at the long end of the curve. So we would say, look, the long end of the curve is going to go sharply upward sloping. And that really is going to happen with two events. One is you're going to get much weaker economies as we move forward. So what the market has to begin to understand is that the short end is going to fall progressively much quicker than the market thinks we think. So like, for example, euro rates could be, have a 1.25 handle at the end of 26, and the long end could be a 2. And that's very different to what's currently being talked about.
Seamus, you're taking the other side of this no landing trade from Torsten Slok, the 10 tailwinds. In other words, that the Fed may need to pause in November, and it was a very expensive insurance cut that we had in the first place.
Yeah, I don't think the Fed pauses. I think we're going to get progressively weaker and weaker economies as we move forward. I think the data is already showing this. I mean, when you think about the U.S., you had like pre-pandemic, we had loan growth in the U.S. running at 4 to 5%. We now have loan growth in the U.S. running at 2. We now have a progressive slowdown in what we have an internal measure of velocity of money. That's slowing. Loan growth is slowing. It just means that we're in the midst of what is progressive slowdown in the private sector. The problem for the markets will be, and you spoke about fiscal deficits earlier, as we get this slowdown, deficits are going to widen. And that's going to be, I mean, you mentioned the Italian spread. We think actually one of the biggest problems in Europe in particular is going to be what's going to happen in France, because we talk about a slowdown. Every 1% lower nominal growth in France results in close to 100 basis points wider deficit. French credit spreads now running around 70 basis points. Italian credit spreads at 130. Progressively, we think actually France is going to go wider than Italy over the next kind of like 6 to 9 months. And I don't think the market expects that at all.
Yeah, Seamus, it really just underscores the new periphery for this European bond market, that you're more worried about France than Italy, for example. How does a European governments, how do they cope? Same with the ECB, this idea that there are deficits, that there are bond market vigilantes who are willing to punish them, but also the need for spending, for capital to help revive a European economy that is flagging at the moment.
I suppose that's really been the crux of the issue for Europe for the last couple of decades since the introduction of the euro, in terms of we don't have this this fiscal union, we don't have this political union. So, we've obviously had the punishment of the periphery from 2011 to 2014. France ultimately will have to be punished in some way. And because we obviously don't have a currency, each region doesn't have a currency, then the only way that this can reflect itself is through the wider credit spread. The problem for France basically is, despite people not wanting to admit this, the French leverage position has basically increased significantly over the last kind of like, let's call it the last decade. But the problem is that real GDP per capita in constant euros has unchanged in France. So, we see it rising in the periphery in Portugal, in Ireland. Italy is basically being constant, but the French credit spread, France cannot grow out of this problem. So the only way the French deficit can be corrected is through some kind of fiscal discipline in a French economy that already spends 24% of GDP on social protection. This is going to be an exceptionally difficult journey for France. If there's a scintilla of doubt about what's going to happen in France in terms of the credit spread, I think this is going to turn into a pretty seismic event over the next kind of like 6 to 9 months.
Given what you're talking about, the fiscal largesse on the European side, we've got Christine Lagarde sitting down today with Francine Lacroix a little bit later on. How quickly does the narrative become that we get to 2%, a little bit more quickly than the market anticipates at the moment.
100%, I think we get to 2% much quicker than people think. Much quicker than people think. We're getting this slowdown in the private sector. It's pretty obvious. I think your prior guest was talking about, auto sales in Europe being particularly weak. This slowdown is happening. We're seeing it on the consumer side. We're seeing it on the luxury goods side. But again, I think the key point here is it's primarily because of this crowding out effect where the government is too involved in the economy. And this is going to increase as economies slow. And that's going to be a big problem in terms of, we have the highest private sector funding need in a generation. I mean, when we think just in historical context, likely, we had China's.
We ask a startup how they're going to grow, how they're going to get users, and they look at us like it's the first time they've ever heard that question. Bad sign. So some sensible idea to try here first. Paul Buchheit once spent a bunch of time looking, one of the YC partners, spent a bunch of time looking at the traits of our best founders and tried to distill down what they were. And he came up with frugality, focus, obsession, and love. I think that is really good. I don't have much to add. But I think these are things that you should be able to say about what you're doing and you as a founder. And finally, I want to talk about why startups get to beat big companies. There are lots of reasons. I'm going to talk about a few common ones here. I think these trends are valuable enough that as you evaluate startup ideas you might do, it's worth thinking about if you fit into these. Because it's really hard for startups to beat big companies most of the time. And here are some areas where we see it happening repeatedly. So I think one difference is if you are a product manager at a big company and you want to do something that sounds like a bad idea but is a good idea, you have to get everybody from your boss, sometimes all the way up to the CEO, to say yes. So one no can kill you. If you're a startup, you can go to YC Demo Day. Any number of the thousands of investors can say yes, and you get to have a crack at it. So it's a very different mindset. And for those ideas that sound bad but are good, because of this phenomenon, this one no versus one yes, startups can win. In fact, startups usually do beat big companies in that category of ideas. So look for ideas that sound bad but are good, and where you are much more likely to get one yes than someone at a big company is to get all yeses. Another area where startups usually beat big companies are in very fast-changing markets. Startups' great advantage is in agility and speed. The more a market is changing, the higher the number of decisions you get to make, and the higher number of tweaks to your product and your strategy you get to make. And you want to optimize the number of those decisions that someone has to make to compete with you, because a big company will make them on average worse and certainly much slower than you do. So the speed of market evolution gives you a lot more chances to compound your advantage over a big company. And then finally, startups usually win on big platform shifts. Many people have observed that startups come in these clusters. Those clusters usually come after a big platform shift. We'll stick with the iPhone example here. After mobile apps became a thing, many new companies got started that are now quite valuable. And one of the reasons here is, most large companies work on sort of an annual cadence at least. And when there's a huge platform shift, they are not good at making a big enough strategic pivot. The battleship just turns too slowly. Whereas a startup can say, wow, woke up this morning, the world is fundamentally different than it was 6 months ago. We're going to go all in on this new direction. And so that's a way that startups usually win. Or that's an area where startups usually win. There are many others, but thinking about these three, I think, is directionally a good thing to do.
And Republicans.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center.
And that's news when you want it with Bloomberg News Now. Get it 24/7
on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
It is Bloomberg Brief. I'm Manus Cranley alongside Danny Berger here in New York. So HSBC kicking off a massive restructuring. The new CEO proposed to cut costs, reduce complexity. Writing in a statement, this is what he said. The new structure will result in a simpler, more dynamic and agile organization. We can focus on executing against our strategic priorities, which remain unchanged. Russell Ward is tracking the story on HSBC. Russell, this is a heck of a shakeup. 4 divisions and essentially splitting the bank from east to west. One could say this is almost a victory for the activist shareholder Ping An from a few years ago.
Yeah, you could say that, Manus. Yeah, definitely big changes under new CEO George Al-Hedary. Let's start with the business lines first. So they're being rearranged into 4 lines. That's Hong Kong, the UK, and then a newly emerged corporate and institutional banking unit that is following internal resistance over the years to combine the investment banking and the commercial banking operations. And then the last one is to create an international wealth and premier banking unit, obviously reflecting the growing importance of wealth management for HSBC. And then you've got the geographical changes on top of that, as you mentioned, splitting into East and West. The East division is Asia Pacific and the Middle East, and the West is the non-ring-fenced UK unit, together with Europe and the Americas. So, as you mentioned, Al-Hedary is really just trying to create a simpler, more dynamic and agile organization with these changes.
Russell, how much of this is a reaction to idiosyncratic HSBC changes versus just a new world for banks where rate cuts mean that costs are under pressure?
Yeah, I mean, I think the bottom line for this is that he's trying to streamline the organization. There were few details in the statement, but there was the language used of trying to avoid duplication, which of course is often code for job cuts down the line. We don't have any details on those, whether they're upper level, middle management, or back office, or all of that. But you know, that's one aspect that has to be found out. Investors are really wanting to know more details. Also, there was no estimate of the size or scale of estimated savings that could eventuate from these moves. So really, you know, a lot of details to come. That probably reflects the rather muted reaction on the stock trading both in Hong Kong and in London as well. And so with the bank reporting earnings next week, that will give George Al-Hedary the opportunity to really put some meat on the bones and explain to investors and analysts, you know, what he's trying to achieve here.
I think it's going to be interesting to hear what he's got to say about putting the commercial and the institutional together. What is it? One builds the business and the other one eats the other person's lunch, something Noel Quinn was against. Let's talk about the appointment of Pam Kaur. She is the new CFO. What do we know about her?
Well, she's the first woman to be CFO in the bank's 159-year history, so that's a big milestone in itself. She joined HSBC in 2013. She has a background in accounting and auditing. She's currently the head of risk and compliance. And she beat internal and external candidates for the job. CFO role, of course, is very, very important at HSBC. Obviously, it's the position that George Al-Hedary himself previously held. And she's going to be tasked with implementing these cost cuts. So she's going to have a job ahead of her when she starts in her new role in January.
Russell, appreciate it. That is Bloomberg's Russell Ward. Now, sticking with banking, but moving over here, U.S. banks will now have to give customers access to their financial data, fueling more competition for financial products. The Consumer Financial Protection Bureau said in a statement, quote, "Too many Americans are stuck in financial products with lousy rates and service. Today's action will give people more power to get better rates and service on bank accounts, credit cards, and more." Joining us now is Bloomberg's Stephen Ahrens. Stephen, for anyone who's lived anywhere but the U.S. knows that we are so far behind on banking and credit card products. So what are the details of this new rule?
So it's actually quite simple. This new rule requires banks to make it possible for their clients to just take their own data, take it under their own hands, and take it somewhere else. So the dominance of banks to just separate that data and keep it to their own, which gives them great power of the client relationship, that's set to at least diminish and make it easier for clients to, if they see a better offer somewhere else, take the client data and go to the competition.
And therein lies the whole point, isn't it, Steve? Good morning to you, which is I can take my data, I can shop around, and I can begin to look at people like PayPal, BetterNet, Venmo. I can begin to look at these fintechs as potential alternatives for some of my banking.
Yeah, I mean, that's exactly the point of this new regulation. The idea is to increase competition, drive down costs, and make it easier for clients to also decide what's the best product. That, of course, means the flip side of that is for banking, it means it will cut into profit margins. If this new regulation actually achieves its goals and makes it easier for clients to choose a new bank, it will probably drive down costs and cut into bank profitability.
Steve, good to see you this morning. Steve Irons on the very latest developments here in the US banking system. Coming up on the show, cut into smaller pieces, why one activist investor thinks Cheesecake Factory would thrive by breaking it up. Context matters on Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Earnings season season is here.
I think that this earnings season is going to be so important.
Bloomberg is first to break the numbers.
NVIDIA earnings now crossing the wire.
Bank of America, the retailer Five Below.
There is something for everybody.
With the smartest insights.
Weaker inflation is not great for earnings.
I think the consumer's a bit more resilient.
You've had earnings recessions flow through growth and then cyclicals and defensives.
Earnings cycle continues on Wall Street.
Continuing coverage on Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Manus Craney alongside Danny Berger in New York. Bloomberg Tech Conference, it's in full swing in London. The executive editor for Tech, Tom Giles, spoke to the ASML CEO a little bit earlier. Let's take a listen.
The focus of China is on mainstream semiconductor. Right. The demand for that has boomed in 2021-22. As a result, the demand we had in China in 2021-22 has boomed as well. And 21-22 was the time, if you recall, where the demand was extremely high and ASML was struggling to deliver tools to everyone. Therefore, we couldn't deliver a large part of the demand in China. Backlog in China grew. 2023, the rest of the market softened. We got tools we could ship to China. Same in 2024. So the level of business we had with China in 23-24 was more of a result of the non-deliver capacity in 22-21 than anything else. And we've always explained that, you know, our quarter at 50% of the business in China, almost 50%, this was not normal. This was a peak resulting from basically a lack of delivery before.
Right.
The normal business in China is around 20-25%. Right. And that's the normal demand related to mainstream semiconductor. And I think we're going to go back to those numbers over time.
The CEO of ASML speaking with Bloomberg's Tom Giles at the Bloomberg Tech London. Okay, let's get you some front page news this morning, 5:23 a.m. in New York. A look at what's making headlines around the world. First up on the Bloomberg, SAP shares rising the most since July. Cloud revenue soaring at Europe's biggest software company. Basically, it's transitioning away from locally run systems with the promise of AI tools and analytics. Cloud revenue specifically a 25% increase in the third quarter. They've also prospered even as Germany's economy has stalled. GDP forecasted to contract in Germany for a consecutive second year in 2024. Of course, SAP has a much wider customer base than just Germany.
Indeed. Let's talk about Reuters. They're leading with the Russian President Vladimir Putin hosting Russia's biggest gathering of world leaders. Now, this is since the invasion of Ukraine. The Kremlin expects more than 30 countries to attend. It's seizing its opportunity to cast Putin and standing up to the West in attempting to reshape the global order. The meeting is the first since the BRICS agreed to extend their membership to 6 additional nations at last year's summit. That was in South Africa.
Finally, the Journal has this. An activist investor is urging the Cheesecake Factory to weigh a breakup of 3 small brands. Okay, Manus, I know you haven't been to a Costco. Have you been to a Cheesecake Factory?
I have been to a Cheesecake Factory in New York, but I didn't see the Tex-Mex eggs. I mean, this is actually part of the reason why we're holding ourselves together on this show, because Danny's going to take me to Cheesecake Factory, and I'm going to have whatever Tex-Mex eggs are.
Literally, you read this story, and you looked at me, and you go, what in the world is it? It's not Tex-Mex eggs, it's a Tex-Mex egg roll, which is maybe even more. The beauty of Cheesecake Factory, Manus, is that they have these giant menus, and you can literally get anything your heart could desire.
If she could have only one restaurant in the world that she would go to and eat, this is an observation of the day, it would be Cheesecake Factory.
Because you could literally have something different every single day. You would never get bored of it.
What about cheesecake?
Unless they break it up and make the menu smaller. I would be devastated.
Cheesecake.
I don't eat cheesecake, too unhealthy.
what's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
From our global headquarters in New York. Welcome to Bloomberg Brief. I'm Danny Berger alongside Manish Cranny. Let's set your agenda.
It's a global bond right as the markets question the Fed's path and fiscal risks. Simpler, more dynamic and agile. HSBC launches its biggest restructuring in a decade. And as global conflict rises, defense company Saab order books surge. The CEO, Mikael Johansson, joins us in just a moment. Danny, good morning. Bond rights of the world.
What a day it was yesterday, basically on no specific catalyst. Here's where we stand this morning. Yields still going higher globally after 10-year in the U.S. moved 11, Germany 10, Italy 15 basis points higher. Was it the risks of a Fed not cutting? Is it the risks of fiscal expansion with a red sweep? Either way, still under pressure this morning. 10-year yield at 4.2%. Equities also had a bad day, especially for small caps. They were slammed. The assumption is higher rates, less cuts, bad for small caps. Banks also hit hard yesterday. Losses across the board. Manis, you pointed this out. The irony of all ironies, NVIDIA still hits a record high yesterday. Dollar is stronger. You can see dollar versus the yen at 150 this morning.
That dollar yen is lit up like a Christmas tree early. I mean, it's up 5% in the past month. The dollar, the musculature of the dollar is huge. I gotta hand it to Kit Duke for the line of the day, which is, in terms of these bond markets, it's blood on the bond floor, never mind murder on the dance floor from a few years ago. But this, look, there was an eruption yesterday. You and I, we sat at the desk and we looked at US bonds up 5 basis points yesterday morning, and just the rest of the world imploded.
It was so fascinating to see, and I think this goes back to what Mohamed El-Erian said a few weeks ago, that global bond markets and markets in general lack an anchor. They don't have it from the Fed, they don't have it from the data, they certainly don't have it from politics. So you get this narrative swing back and forth that continues to lead from this whipsaw. The question is did we go too far again in one direction yesterday?
Well, look, an 11 basis point move is quite significant. Then you look at papers from the likes of Torsten Slok over the weekend, talking about 10 tailwinds for the United States. And again, this invokes the narrative, whether it's from Torsten or whether it is, as you said, from Adam Posen, which is a pause in November, and maybe even, according to Posen, you and I have spoken to him several times, is the possibility of having to reverse and hike into next year.
And let us not forget, oil prices were also higher yesterday with a threat of geopolitics.
Indeed, and geopolitics is part and parcel of the next story, really, because conflicts, they are raging between Ukraine, Russia, in the Middle East, and nations in Europe and beyond. Still, they see the need to replenish the defense stocks. Those efforts are long-term. That is according to the CEO of Saab, Mikael Johansson. He joins us now. The Swedish defense company posted strong sales growth and cash flow in the last quarter. Michael, good morning to you. Well done on the numbers. A number of analysts have said you've triggered relief. large prepayments. 80% of your orders were from international sources. I want to get an idea. You say you're not overly reliant on one government. So where was the spread from? Where were your biggest orders from? Good morning.
Good morning, and thank you for having me. Well, the contracts are mainly in the Western world, and European countries, of course, some of them are spending a lot on defense, especially the Eastern European countries like the Baltic states and Poland, but also other European countries, of course, and in the Western world, also the US. So I think we're seeing a really attractive portfolio from our side that we have in the marketplace, and a big demand on that, especially on the sensor side of things and on the advanced weapons side of things, the dynamics and the surveillance business areas. So it's been a great quarter in that sense.
Michael, we've caught up a few times over the past year or so. How would you describe the spending and the fear that's coming along with that? The fear that you see from these different countries and their needs to prepare for the threat of an actual hot conflict?
Well, I think it's long term. I think even though we hopefully get an end, so Ukraine wins the war, and we still need sort of come out of this peace dividend and replenish stockpiles and build capabilities and take a bigger responsibility as European countries for our own defense, not being that dependent on the US, even though the transatlantic link is important. And then we need to help Ukraine build sovereign capacity and capability as well. So I think the growth and the demand side will be for quite some time.
You talk about a replenishing of defense stocks there, but are we entering a new materially demand-driven growth cycle?
Well, I think it's a mix, I think. We, honestly, I don't know what levels sort of stockpiles are at in different countries, and I shouldn't. I don't know whether our deliveries go straight into the stockpiles or they go being donated to Ukraine. I think sort of hard material is going to be used and needed, and you need to have more security of supply and deterrence levels than we've seen before. I mean, look at the 155 millimeter that we don't do. I mean, no contracts had been in place since the 90s when this surge started. But it's also a new capability movement and using new technologies, of course, using drones to achieve things we did with large platforms before. So the whole industry is embracing new technologies and investing heavily, of course, including us, in new capabilities. So it's a mix of things. It's capacity, it's new capabilities, all at the same time, and growing while we're doing that in a controlled way.
Michael, when former President Trump, now candidate Trump, was speaking to Bloomberg just last week, he said, our allies have taken advantage of us more so than enemies. He's threatened to let Russia do, in his words, whatever the hell that they want because of the lack of spending from Europe. How much of what you're seeing is in preparation and getting Europe ready for a potential Trump 2.0?
Well, my perspective is that it's right that European countries and Europe have to take a bigger responsibility when it comes to capabilities and capacity and defense spending, independently of the administration in the US. Then we need to work with the US and have a great collaboration, of course, with industry and the government, independently who is the president. So that's the direction that is important, that we move into that direction. And the Commission in Brussels is trying to do everything they can to incentivize collaboration, create scale, getting countries to spend more money on defense and in the European Defense Industrial Program going forward, so we can align requirements, create scale, and do more together. And that's the direction we have to go. So, of course, we have to take a bigger responsibility, and we are in a hurry to do that.
Can we just flip to the other side of that coin, which is if there is a Harris victory and Harris in the White House, given what you've just said, that does not sound as if it's a material risk to your business nor to the growth of your business.
Neither, I think, is a material risk to our business. I mean, we will continue to invest heavily and grow in Europe and support Europe to create bigger capabilities. We will grow our business in the US, and I don't think there is any connection to our local business with 1,000 employees and what they do, depending on sort of the outcome of the election. It's just a sort of a sound direction of making sure that we have a bigger responsibility for our own capabilities and deterrence in Europe. And I think both administrations would support that direction. It's good for the US, it's good for the Europe as well. So I'm all in on that, and I think that will not be dependent on the election outcome.
Michael, then what difference does it make if there are talks of an off-ramp in Ukraine, hopes for a ceasefire? What difference would that make to your business?
As I said, I don't think, I have a difficulty seeing that the politicians in Europe would just sort of go back to a peace dividend type of perspective of things. I mean, what we have now is an unpredictable, aggressive neighbor to the east, and that will be for a long time. So European countries have to build sort of the capabilities they need. Look at Poland, an Eastern Shield, spending sort of 4.5% of GDP on defense. No compromises. They will protect themselves. So that's what we see. So even if we see a ceasefire and hopefully a win to Ukraine, it will still need lots of demand to replenish stockpiles, new capabilities, and help Ukraine building sovereign capabilities. So I think the demand is long-term.
Understood. Michael, thank you for joining us. As you say, we're in an era of European countries taking more responsibility. Michael Johansson of Saab, thanks for your time this morning. Coming up, bearish bets on the dollar are evaporating as we approach the election. We're going to discuss with Skyler Montgomery-Koning of Barclays in person in New York. That's coming up next.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
It's your Bloomberg Brief. Danny Berger and Manus Cranny here in New York. So we are somehow officially 2 weeks away from the U.S. election. I have no idea how we got here, but speculative currency traders have been swinging from bullish to bearish on the dollar all year as the polls continue to show a razor-thin gap between the candidates. The betting markets, though, surging for Trump. And yesterday saw the biggest positive swing in sentiment in 3 years after a bunch of bearish bets against the greenback were reduced by about $8 billion. Joining us now is Skyler Montgomery-Koning from Barclays, pleased to say in person here in New York. So you get bearish dollar bets evaporating. The euro weakens 0.5% yesterday versus the dollar. The yen goes back through 150. How justified is this dollar strengthening we're seeing?
I mean, I think it's absolutely justified, and I'll give you a couple of reasons for that. It's not only the U.S. election and this shift in odds that we've had in favor of Trump, it's the fact that the U.S. economy is growing above potential, and you can't say that about any of the DXY counterparts. And that above potential policy feeds into less dovishness from the Fed, and I think that was the #1 driver we saw for the U.S. dollar over the last 2 years. It was pretty much a 1-for-1 correlation that you had Fed odds for dovishness come off and the dollar rally, and so I think that's the fundamental basis for this rally. And then over the last 2 weeks, you've had it extended beyond because of the election outcome shift in odds.
So fundamentally, it's about U.S. exceptionalism, but you look at the demonization of the euro with the data, which justifies it. Then you look at the peso, down 3%. If we go to a Trump victory, maybe even a red sweep, how much more aggressive can this dollar rally in the near term be then?
Absolutely, you can get more aggressive with the dollar rally. Quite a lot of Trump's policies are dollar supportive. So you think about fiscal, that's pro-growth, it's pro-inflation. That means you need a more hawkish Fed, that's pro-dollar. If you think about tariffs, because of the import substitution effect, again, it's higher dollar. And so for us, when we're thinking about a Trump victory, we've done some modeling of what you could potentially see. And on Eurodollar, you could see as low as 103 or even lower, I think.
With emerging market currencies, because Manus mentioned that the peso sank by some 3%, you have a Fed starting a cutting cycle, which is obviously supportive for EM. How do you weigh that up against potential tariffs and those types of risks for EM?
Absolutely. So, I mean, tariffs, it's not only the impact you get through import substitution for the dollar, but it's also confidence effects, right? So when you have tariffs, they shake global growth, they shake global trade, and dollar strength in itself also feeds into that loop. And so it's quite negative for EMs, especially those that are directly targeted. I think that's more negative for EMs than any potential feed through you get from the Fed, although it is supportive for EM growth because they're allowed to ease because the Fed is easing.
Look, part of yesterday's disruption, unanchoring, whatever phrase you want to use, was the bond market, very much across the curve, right the way across the curve. As Kit Duke says, there was blood on the bond floor. Where do you stand in terms of the narrative that the Fed may pause? Because you look at the rhetoric from the Fed speakers yesterday, and it wasn't as much about pause, it was about recalibration. Where are you in that debate?
Yeah, I mean, it's interesting. We've had this massive turnaround on the narrative in the U.S., right? We've gone from thinking about recessions and the unemployment rate rising to a very strong labor market. I think, you know, they set out a path for gradual cuts for the end of the year. You need to see very strong data to have some kind of skip. But it's not an impossibility by December by any means. I think we just need to see how the data comes in. And my worry is because we have these idiosyncratic events in terms of hurricanes, in terms of strikes, that some of the data will be weaker in terms of non-farm payrolls, the one we get before the November MPS. We could see some weakness there, and I think the Fed looks through it, but it doesn't necessarily mean that you don't get a cut. It means that you probably get 225s rather than, I mean, 50 is pretty off the table now, but rather than a skip.
But we're going to be having a Fed decision in the fog of a U.S. election, in an election that could take days to figure out who is the victor, as we have confusing data. Just the November decision itself for the Fed. What are we likely to hear out of them when you can't trust the data and you don't even know who probably is going to be in the White House?
Yeah, well, this is really the struggle. There are so many cross currents right now. We have bang, 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 non-farm payrolls, election, Fed, right after the other. And so I think for them, they're just wanting to stay on message from what they said last time. And I think the near-term path is actually relatively clear in terms of gradual cuts. The question over is 2025. Where do we land? And that's really been the driver for the dollar as well as for fixed income.
And that's where everybody's skimming back in terms of in terms of what we can deliver from 200 down to 150 basis points now. There is this concept that we de-risk. We de-risk into a contested election, a red sweep. We don't know what the outcome is going to be. In a de-risking scenario for markets, is that dollar positive?
Yeah, I think it's dollar positive, and that's what we're seeing right now, right? If you're having to put your money somewhere, you'd rather put it in the dollar than anywhere else. And I also think, you know, part of it is where the odds move you. You get strong dollar upside on a Trump victory, but you just get a little bit of relief on a Harris victory in terms of you only get a little bit of dollar downside in that scenario. And so the risk reward is in your favor to be in the dollar rather than not.
The IMF pointed out, they have their fall meetings in DC today actually. They pointed out that global debt, public debt, is going to forecast $100 trillion this year, rise further in the medium term. You saw a bit of that in yesterday's market, not full-on vigilantism, but a bit of it. Do you understand the market's ability and bond yields' ability to kind of bully governments into pulling back in deficits?
Yeah, I mean, I think the U.S. is a little bit of a different case because it is the world's reserve currency. People are always willing to buy U.S. government debt, but certainly term premia is very compressed in the U.S. still. We've had kind of paying attention to term premia in fits and spades. We're in a bit of a different environment than, say, last year because we're in a cutting cycle. We're not in a hiking cycle, but certainly you could justify higher yields off the fact that you have a bigger deficit or even just returning to kind of a more normal term premia than you have historically.
And we didn't even get to dollar yen, and it's on a ripper. We'll save that for the next time. Skylar, thank you so much for being with us this morning. That's Skylar Montgomery-Koenig of Barclays. And don't miss Bloomberg's exclusive interview with the ECB President, Christine Lagarde. That is at 10 a.m. New York time, 3 p.m. in London.
And just before that, I'm going to be catching up with Robert Holtzman, the gentleman from the Austrian central bank, some other big players too in global banking at the Bloomberg Global Regulatory Forum. You can catch that at Live Go on your terminal, 9:45 a.m. New York time.
Well, let's turn to politics now. Out on the campaign trail, minimum wage is just the latest topic that the Vice President Harris held up to take a jab at her Republican opponent.
My opponent, Donald Trump, does not believe we should raise minimum wage. And I think everyone knows that the current federal minimum wage is $7.25 an hour. I absolutely believe we must raise minimum wage and that hardworking Americans, whether they're working at McDonald's or anywhere else, should have at least the ability to be able to take care of their family and take care of themselves in a way that allows them to actually be able to sustain their needs.
Now, this comes just a day after the former President Trump stopped by McDonald's serving fries to voters in Pennsylvania, causing quite a stir. Michael Shepard is with us now from Washington. Michael, good to see you. Look, the whole emphasis here is about the blue wall. That's where Harris was spending her time. They want to make sure that they really go after. I mean, the swing voters are, what, 4%, 1.2 million voters. This is the critical target market for them in these closing days.
That's right. And they're really trying to reach people where they are on the economy because Harris believes that that is a winning message increasingly for her. She has closed the gap on this issue with Donald Trump ever since the summer. And while they're not polling quite evenly, her message about creating an opportunity economy is something that is starting to resonate with those voters. And they are looking for the handful of undecideds out there, including a number of Republicans who can't abide by voting for Trump, but haven't quite made their minds up yet to cast their ballots for Harris. And the whole question of minimum wage came up because over the weekend, the publicity stunt from Trump appearing at the McDonald's, it gave Harris an opening to talk about the minimum wage. The former president was asked, do you favor raising the minimum wage from $7.25 it's been since 2009? And he said nothing. He did not take the question, didn't really answer it. And so that gave her an opening to talk about this key issue to many voters who feel like they're struggling.
Shep, into this final stretch, the campaign finance figures we've gotten for Harris is quite stunning. More than $1.1 billion in the third quarter. That's more than twice of what Trump and the Republicans took in. Just 2 weeks away. How useful is that type of money?
Well, you know, look, money can't buy us love, as we know, but it can buy so much in terms of digital advertising, TV advertising, and radio advertising, and help to finance some of the get out the vote efforts that will be important to making sure that they have the turnout that they need to defeat Trump. And the Republican side is looking to do the same thing. They are leaning on a lot of deep-pocketed donors like Miriam Adelson and, of course, Elon Musk, the world's richest man, to help bankroll those efforts on the Trump campaign side. And in fact, what was interesting in the Trump numbers that came out over the weekend is that he is leaning much more on those super wealthy billionaire-type donors to write big checks. checks than he has in the past. We all know that Donald Trump has, one of his superpowers really as a politician has been able to raise money from small dollar donors, people writing those little checks, clicking on his website, responding to those pleas, people who attend his rallies and support him financially that way. This time around, it's the reverse. He raised more than $500 million from people who gave $1 million or more, whereas much less, roughly half that from the small dollar donors, people who gave $200 or less. And that was kind of the reverse for Harris. She got a lot of money from large donors, but she also got quite a bit in terms of small dollar contributions from individual contributors.
Yeah, and it's not even just that it's a big name in Elon Musk. He's willing to go on the stump for Trump, too. Hey, Shep, we appreciate your time this morning. As always, Michael Shepard in Washington, D.C. Coming up, we're going to set you up for your trading day earnings, exclusive central bank interviews, all of that to come throughout your day.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
DOJ or other authorities
Could face bigger challenges next.
Fed was going to keep World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington. It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment. Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
It's your Bloomberg Brief. Danny Berger and Manus Cranny in New York. Let's get you set up for your trading day on this Tuesday. GM, GE, Kimberly-Clark, Lockheed Martin, they all report results before the opening bell. BOE Governor Andrew Bailey, he will be speaking at 9:25 a.m. at a Bloomberg event. And don't miss our exclusive interview with ECB President Christine Lagarde. Manus, that will be at 10 a.m.
Yep, let's see what she intimates in terms of the trajectory for rates. We just had Skylar where they're talking about euro-dollar down at 103 is her target. But there is, to quote Kit Jukes, it is the line of the past hour. Blood on the bond. floor. And we're not talking about murder on the dance floor, but we are talking about the eruption. I would say the Burrs were erupted in the US and the vigilantes were sparked in Europe. I think there is a difference. I think there is a difference between the two.
But it all could come down to this idea of fiscal spending, deficits increasing.
Yes.
So you do get the vigilantes, more coming out in Europe, more coming out in places like Italy, and then you also had Fed speak to contend with too.
And the Fed speak is interesting because Kashkari makes the point that bond rates are still actually, you know, having as he said, pressure on this economy. It's still putting our feet on the brakes of this economy.
Yeah, elsewhere, bonds continue to chart higher. We'll track it all for you. Surveillance, that's up ahead.
In terms of how we should deal with the challenges that are, facing the world and also internally, I think it's just an opportunity also, an angle. And you could see that in a lot of activities that are picking up in this region, simply because it's a region that is actually a bright spot amongst very few in the world today. And people always talk about the flavor of the month. Actually, I don't want to sound too, large-headed, but actually we will be the flavor of decades. We are determined, we have long-term plans, and we are very clear and committed on our commitment to the investment community at large. I'm not talking about one individual country, but at large in the GCC, that we mean business, that we are willing to take every step possible to make it easier for investors to do business in the region, that we are willing to do a lot of structural changes, including actually making it very predictable, very consistent policies.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
If you look at the environment, at least in the U.S., it is pretty encouraging. Stocks reflect that.
If you're printing earnings growth like we're printing, then I think it's going to be hard to keep people out of U.S. equity markets.
Sentiment is probably not overly enthusiastic, but certainly bordering there.
At these valuations and at these levels, it makes it hard to have a positive surprise, and it makes it easier to have a negative surprise.
At the same time, look at equities. That's where I look for opportunities.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now with the fireworks in the bond market. 410 becomes 420 in just 24 hours. Your 10-year right now, 420.56, up a single basis point at the front end of the curve, back through 4%, 4.04% on a US 2-year. Is it the data? Is it Fed expectations? Or is it the so-called Trump trade? Renmax Neil Dutta, financial markets have a lot of Trump priced in. Morgan Stanley's Mike Wilson, markets may now be offside should Harris win?
Yeah, basically buy the rumor, sell the news, and that's basically what we see, or what a lot of people are saying we're seeing in the bond market. Everyone has said the clearer trade for whoever wins, in particular, more so if Donald Trump wins, is that bond yields will go higher, and that is what is getting priced in at a time where the data is also coming in stronger than expected and supporting that idea that maybe the Fed can't cut as much.
And potentially, this is the Trump trade. The fact that next year, as Adam Posen has said to us on this program for months, and also yesterday, that if you have blanket tariffs on day one, that could be highly inflationary. So this time next year, you could have a Fed that potentially is in a hiking cycle. Or is this the fact that the market has actually waken up, that we are 2 weeks away from the U.S. presidential election, and regardless who wins in 14 days, there is going to be a lot of fiscal spending.
The list is long. There's plenty of reasons for this bond market move. We said yesterday it's very difficult to disentangle the politics away from the data, as Lisa mentioned. Upside surprise after upside surprise, particularly what we saw with retail sales just last week. The note I would make this morning, it's global. It's a double-digit move on a US 10-year yield. It's the same in Germany in the last 24 hours. Even in Australia, we saw a 16 basis point move. It's not isolated to the US bond market.
It seems as though there is a global acceptance that maybe people got over their skis when they believed that we're going back to very low rates. Maybe this has to do with the IMF pointing out that there's $100 trillion of debt outstanding, public debt. I don't know. I don't think that that's the case. Some people are attributing that, but they say that every year. There is bigger concern here that this is a market and this is a world that is more inflationary fundamentally. And all of the ideas that we were heading in this perfect disinflationary trend back to 2% are being fundamentally questioned.
Just a touch of pushback from Ian Lingen over at BMO. This is what he had to say. It's difficult to envision an outcome that would warrant another 25 to 30 basis points higher in 10-year yields outside of a GOP sweep. So if you get the GOP sweep, then yes, we start to price in a whole lot more. And we talked about this yesterday. Maybe you could see 50 basis points in just 2 days. Outside of that, bit of pushback from Ian Lincoln.
Basically, the argument being that it's not just tariffs. It has to also come with tax cuts and other types of more stimulative actions that could actually cause earnings to rise. That is the only way that you could get that. Otherwise, people will be pricing in the weakness that probably would come with maybe reduced trade or reduced activity.
But when you look at the congressional map, Democrats have more seats to defend when it comes to the Senate. And then just yesterday, Pennsylvania, which is the bread and butter of this election cycle, Pennsylvania yesterday, Jessica Taylor coming out with a report on the Cook Political Report, moving the Senate seat, Bob Casey's seat, to what is going against Dave McCormick, to now a toss-up. That was lean Democrat. Also what happened in the past 48 hours. 538, Nate Silver's shop, has moved Pennsylvania for the first time since July. Trump winning that. It is marginal. This is on a knife's edge, but there are little increments that are moving towards the GOP favor.
That's where the momentum is right now. In the equity market, these are the scores for you. On the S&P 500, negative by 0.5%. Underperformance once more on a Russell to small caps. We're down by 0.9% on a Russell this morning. Later, the next stop for the equity market, GM earnings later this hour.
Do we get a different story from the U.S. auto manufacturers versus the European auto manufacturers? I find it fascinating that the Russell 2000 is underperforming. It is the most sensitive to rates going higher. You wonder if auto manufacturers give a similar nod to the fluctuations in their business on the heels of borrowing costs that are more or less accommodative.
Looking for those numbers to drop around about 6:30 Eastern time, so 25 minutes away. Coming up this hour, we'll catch up with Sharon Bell of Goldman Sachs, predicting muted future returns in equities. Terry Haynes of Pangea Policy on Elon Musk's $1 million prize. And Kurt Ryman of UBS as the bond market begins to price in the so-called Trump trade. We begin this hour with the equity market rally stalling after climbing by more than 20% so far this year. Goldman Sachs says the decade of big S&P 500 returns might be over, writing, we estimate the S&P 500 will deliver an annualized nominal total return of 3% during the next 10 years and roughly 1% on a real basis. Goldman's Sharon Bell joins us now for more. Sharon, welcome back to the program. Just walk us through what underpins that view of very muted gains compared to what we have delivered over the last 10 years, looking out another decade.
Yeah, I should say that analysis comes not from my team here in London and Europe, but from our US strategy team, which actually in some ways makes it more compelling because the US equity market has done so incredibly well in the last year, as you point out, up 20% or more, but also in the last decade, it's been an incredibly strong performing market. And yes, their view is that you get lower returns over this next 10 years. And the basis of that view is really two things. One is that valuations are sort of above the 95th percentile at the moment of the historical range. So you're already paying a lot for this market. And the second is it's very concentrated. And that, of course, ups your risk. It ups your idiosyncratic risk, particularly. So those two reasons, they think the returns from here will be a bit lower.
Sharon, how does that compare to what you expect for European returns?
Yeah, so European returns, we wouldn't have particularly strong returns for Europe either. Now, Europe's in a bit of a different situation in that valuation is nowhere near as stretched. So I mentioned the US equity market on a basic PE would be above its 95th historical percentile. Europe isn't there. On a PE, Europe is about long-term average at the moment. And that would suggest that European returns could be long-term average, maybe 6, 7, 8% over the next decade. The warning, though, here is that European return on equity isn't as strong as it is in the US, and earnings growth is weak too. We recently downgraded our earnings growth figures for next year for Europe. We only expect really 3 or 4% earnings growth over the next couple of years. We don't really expect a re-rating either. So we don't expect the PE to go up, and the E is only going up 3 or 4%. So that only gives you low returns, really.
Sharon, let's just talk about the next 6 months or so. Right now in the United States, we're talking about how we're pricing in something of a Trump trade in the equity market, in the bond market. Maybe that's part of the reason we've seen yields rise in the United States, and maybe that's part of the reason why we've seen an outperformance in the financials. Is the Trump trade getting priced in for European equities?
Oh, this is a great question. And I do think that it is a Trump trade, partly, which is pushing bond yields up globally, especially in the US. You're starting to see that priced into certain areas of within the stock market as well. I do feel that Trump, and especially any talk about increasing tariffs in the US on global goods coming in. Europe is a big exporter to the US. European companies are global earners. They've benefited in the last couple of decades from large growth in open global economies, and anything that draws back on that, I think, is a bit of a negative for European equities in particular. But we have seen a similar situation in Europe. European banks doing very well, partly because their earnings have been very good, but also they're seen as stocks that perhaps are not so linked to global trade and therefore wouldn't be hit by any increase in tariffs.
You have some specific numbers around how much you could see earnings per share decline in European companies if Trump gets in, if he puts on some of the tariffs that he has pledged to do so. How much of a decline could we see in the overall equity picture in Europe should some of these things go through?
Yeah, absolutely. So if you were to get 10% tariffs on all global goods going into the US, and also some retaliation from Europe too. So this would kind of shrink global trade growth. We think that could take off up to 9% from European earnings. Now, that's huge. I just said before that European earnings in the next couple of years, earnings per share growth, we only expect at sort of low single digits. So if you took off 9% from that, that was already quite a large amount. That all being said, there could be some offsets here. And Trump has also talked about, for instance, tax cuts. And European companies do have a big chunk of their businesses in the US, and they would benefit from lower taxation there. So there could be some offsets, but yes, up to high single digits hit to earnings.
Sharon, what about the fact that just a threat of tariffs, would that in itself hurt European equities, even if Donald Trump did not, go through with his plan as he's promising right now?
Yeah, in fact, we think a lot of the damage is done via sentiment and uncertainty. Almost once you know for certain, in many cases, it's already been priced in and some of the damage has already been done. So I would expect even, if you don't actually see the 10% global tariffs, just the concern about it could up the risk premium people apply to Europe, and some concerns about its exposure to global trade. So yes, I think a lot of it would just be a hit to sentiment.
If you're a European equity trader, are you more nervous about what China is doing in terms of their policies, or are you more concerned about the trajectory of the United States?
So I think I would have answered that by saying that I was much more concerned about China a few months ago, because at the time, China, incredibly weak economic growth, clearly overproducing, sending a lot of those goods into Europe, pushing down goods prices in Europe, more competition, particularly for European autos, all very negative, really, for European corporates. But now, with China stimulus coming through, maybe you've cut off the sort of worst case, left-hand tail of incredibly weak China growth into 2025. So I do still worry a little bit about China. I do still feel that you'll see excess production in China of lots of different goods. You will see lower goods prices into Europe, helpful for inflation, bringing that down, but not helpful for corporate profits. For the US, though, I do worry about policy because, of course, we find out in not so long which way policy will likely go. Any tariffs globally, I think hitting global trade is a big concern for Europe.
Hey, Sharon, always great to catch up. Appreciate it. Sharon Bell there of Goldman Sachs on the US versus Europe. Difficult session for Europe. FTSE MIB over in Italy down by more than 1%. Likewise on the IBEX over in Spain, negative by 1.2. If we get that GOP sweep, you have to imagine some of those companies in Europe might be between a bit of a rock and a hard place.
Exactly, especially if you get what Sharon Bell is talking about, something like 9% taken off earnings per share. You just have to wonder whether the approach is the right one when you have these IMF and World Bank meetings, and you have all these world leaders coming down decrying the deficit. Should there be a little more focus on maybe how they're going to support some of the industries in their region if that ultimately is one of the big challenges?
Yeah, more headlines about innovation and maybe not finding tech firms based in the US.
Well, I was looking, for example, at some of the tax rates, and they're going up in Europe, and they're expected to either go down or stay the same in the US. You start looking at potential for innovation. You look at all of these things, and you start wondering, yeah, I get the deficit. I am a big deficit warrior. I say, oy, the deficit. However, there is also room for what are you doing on the other side, especially if you have some structural issues in certain key industries.
European equities softer this morning. Here in the United States, S&P 500 futures negative by about 0.5%. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Shares of SAP rising nearly 3% in the German trade. Europe's biggest software company reported a jump in third quarter cloud sales. It's working to move customers to its AI tools and analytics. Cloud revenue rose nearly $5 billion. That's a 25% increase from a year earlier. Its cloud backlog rose to over $16 billion. BHP has gone to trial in London over a 2015 dam collapse at a Brazilian iron ore mine. BHP is accused of trying to avoid paying billions of dollars in compensation to those affected. The London case will test just how far English courts are willing to punish firms over environmental disasters that happen far away. More than 620,000 Brazilians are seeking around $47 billion. Elon Musk and Tesla are being sued by Alcon Entertainment. The studio says that Tesla used imagery inspired by the 2017 movie Blade Runner 2049 at its recent robo-taxi event after permission was denied. Alcon also alleges that Tesla didn't reach out for permission until the day of the event. Musk, Tesla, Warner Brothers Discovery, which hosted the event, are all listed as defendants. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. Up next on the program, Election Day, 2 weeks away.
I absolutely believe we must raise minimum wage and that hardworking Americans, whether they're working in McDonald's or anywhere else, should have at least the ability to be able to take care of their family and take care of themselves in a way that allows them to actually be able to sustain their needs.
That conversation just around the corner, live from New York City this morning. Good morning.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Equity futures negative here by 0.4% on the S&P 500. Yields just a little bit higher. Once again, 420 on a US 10-year. Under surveillance this morning, election day, just 2 weeks away.
My opponent, Donald Trump, does not believe we should raise minimum wage. And I think everyone knows that the current federal $2.25 an hour. I absolutely believe we must raise minimum wage and that hardworking Americans, whether they're working at McDonald's or anywhere else, should have at least the ability to be able to take care of their family and take care of themselves in a way that allows them to actually be able to sustain their needs.
So here's the latest. Kamala Harris and Donald Trump doubling down on swing state voters. The vice president stopping in Rust Belt states Michigan, Pennsylvania, and Wisconsin, while Trump is making the rounds in North Carolina. The polling still incredibly tight. USA Today, Suffolk University, showing Harris leading by just 1 point over Trump nationally. Bloomberg's Mike Shepard joins us now for more. Mike, welcome to the program, sir. Let's talk about where this campaigning is taking place and why the former president is spending so much time in North Carolina.
Well, John, I'm glad you brought up the Tar Heel State because Donald Trump is now devoting a lot of resources there. Over the past 2 days, he will be making 4 appearances within about a 48-hour span, and that just signifies how important this is to his campaign. We talk a lot about the Democratic blue wall of northern industrial states, but North Carolina is shaping up as something of a red wall for Trump. He won the state in 2016 and again in 2020, but in the last election against Joe Biden, the margin was pretty tight when it came to his victory there. And Democrats are seeing the state as a potential pickup opportunity. So Trump has been crisscrossing the state over the past 2 days, and he has a rally scheduled there tonight where he will try to drive home a couple of key points. One, of course, is on the economy that we have heard again and again that if you don't like the economy now, why are you voting for Kamala Harris to bring back more of the same? But he's also seizing on the recent natural disaster in western North Carolina as a way to highlight what he calls incompetence by the federal government. And that was something he raised yesterday during his visit to the Asheville area.
Shep, already today, 15 million people have voted in early voting. But when it comes to a state like North Carolina and some of these other southeastern states that were ravaged by the hurricanes, how hard has it been for people to get out and vote?
That's a great question, Anne-Marie. The storm had such a devastating effect on the region in terms of really just disrupting people's ability to access basic needs, to be able to get to work. They've lost their homes, they've lost their livelihoods, and hundreds of people lost their lives in these disasters. And so voting, you would think, comes after all those basics. But many people have been really trying to rally to get to polling places. We've seen lines in Asheville that were already very long. And the state is making some accommodations so that people can get absentee ballots sent to their temporary addresses if they've been displaced. And voters will be allowed to cast ballots anywhere in the state as needed if they've been displaced. So they've made some accommodations, but it will be difficult. And it may also complicate how the vote tally is conducted toward the end. So this is something we're paying close attention to. And it's important to note that while the former president has been raising concerns and allegations and accusations about the delivery of aid in this region, state and local officials have generally praised the federal government, and they have faulted some of the disinformation and false claims that the former president and his allies have been making about how FEMA and the Biden administration have been performing, too.
Shep, appreciate the clarity, sir. Down in the nation's capital, Bloomberg's Michael Shepard with the latest from Washington, D.C. To continue the conversation, Terry Haynes of Pangea Policy joins us now. Terry, welcome to the program. This market and some market participants believe that this bond market is starting to lean towards a Donald Trump win. Polls are still incredibly tight. How do you see things?
Well, I'm still of the view that Harris squeaks out a win, but what you've got with Harris is a combination of a split political Congress with a Republican Senate and a Democratic House, again with bare majorities. So you've got kind of a remixed status quo on policy, frankly, and I think this is the time of year where in the markets people get way over their skis on a political result. In 2016, the way over the skis was all about a completely blue Washington, and we know how that turned out. So I'd urge people to pull back and take a look at what's actually happening on the ground.
Well, let's pull back and look at what's actually happening on the ground in Pennsylvania, Terry. 538 Nate Silver now has Trump in the lead there, the first time since July. And the Cook Political Report moved the Senate race there to a toss-up. Prior, it was lean Democrat. Those are not good signs for Kamala Harris in a state that is a must-win for Democrats.
No, they're not. But I think what that is all about is about polling numbers, and then we should take those seriously, but not literally, as a friend of mine once said. And we should also look at things that are intangibles. And I think the intangibles, like the turnout machines and the ability to bring people out, is what gets Harris to prevail barely in Pennsylvania. 2016. Democrats got surprised. 2020, they didn't get surprised and they barely won. The Harris campaign has had a ground game that was inherited from the Biden campaign, and I think, frankly, that's going to be just enough to have it win there.
Terry, John brought up what Neil Dutta said, which is basically a lot of Trump is priced in. He goes on to say this is not like 2016 when predicting markets had him under 20% in the week before the election. Today, Trump is above 50% across a variety of different polling averages and betting markets. Why don't you agree with what is currently being priced in the polling and betting markets? What are these polls getting wrong?
I just think what the polling shows is a very, very tight race. So it's really down to turnout. That's kind of a trope, but it's also true when you've got a neck and neck race. And I think that the intangibles on the Harris side probably get her to enough votes to win. Frankly, the way to put this in Pennsylvania, for example, since you were using this as an example, is that the turnout in the Philly and the blue suburbs kind of overwhelm the rest of the state, the vast majority of the rest of the state, which is red. Trump's trying everything he can to pump up kind of red turnout, particularly people that don't come out and vote a whole lot. But my own bet is that methodical turnout is going to do better than kind of scattershot work at the very, very end.
Terry, is there anything in particular that you have your eye on that could potentially change the race in a more material way in the next 2 weeks?
The next 2 weeks, no, I don't think there's anything real serious. Markets will whip themselves up about jobs reports and a whole bunch of other things, but fundamentally, a lot of people like to talk about these elections like technicians. One issue or another is going to matter, and all the rest. And in reality, 70% of these folks will already have voted before Election Day, and the people that are holding themselves back aren't thinking about one issue or the other. They're thinking about, who do I want who do I want running the country in the next 4 years? Is this Harris person really okay? Am I willing to put up with another 4 years of Trump? Do I like 4 more years of Trump? What am I going to be doing? That's the kind of basic, people like to call these things existential choices, but that's the kind of basic choice that undecided voters are looking for, and that's not easily charted.
Terry, it's good to hear from you. Terry Haynes there of Pangea Policy. The closing arguments on a campaign trail through the next 2 weeks. The former President Donald Trump leaning into a very simple one. Is your life better now than it was 4 years ago? And we heard that a few times.
And this was the line that he should have used at the debate, but he waited to the very end of the debate to use, and now he's trying to hammer this home. It's 14 days. What you do see is them going to the swing states. They have to go to where the constituents are they want to come out and vote. Yesterday, where was Kamala Harris? The entire blue wall. With who? Liz Cheney. They think that this is potentially someone that could tell Republicans, it's okay, you can vote for her. What I find fascinating is that then you had Tim Walz on the Daily Show with Jon Stewart saying, I think Liz Cheney and Dick Cheney give permission to those folks who want to find a reason to do the right thing. we're not going to take their foreign policy, though, decisions and implement those. Well, if you're a Republican that is, say, a Nikki Haley supporter, that's the reason why you would maybe want them to take their foreign policy.
What are you voting for?
Exactly.
Doubling down on swing state voters over the next 2 weeks. Equity futures on the S&P 500 near session lows. We're negative by 0.4%. Up next on the program, earnings from GM and a reaction from Bloomberg's Craig Trudell. From New York, this is Bloomberg.
Many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Equity futures just a little bit lower. We're negative by 0.5% on the S&P, down 0.6 on the Nasdaq 100. On a Russell 2000, down by 0.8%. This equity market needing to process what's happening in the bond market, so switch up the board. On a 2-year, 10-year, 30-year, yields higher, much higher through yesterday's session. Just a little bit higher this morning, up almost a basis point on a 10-year, 420.17. On a 2-year, up a single basis point to 4.04%. The focus on the earnings this morning, GM just dropping, and it's some good news for General Motors.
Yeah, when you take a look at earnings per share for the third quarter, it's $2.96 versus the estimate of $2.45. But you look through, and it's a raise, talking about $10 to $10.50 for the full year adjusted earnings per share. That is in the higher range of where they had originally been expected to come in. What is amazing to this is how different the tone is from European auto manufacturers. They're talking about how even in China, sales are improving from the second quarter. They're working through their inventories. In the U.S., they are cutting costs. They are increasing their revenues from EV production, and they are actually on track to generate a profit from their electric vehicles. This is a very different story than the Volkswagens and the BMWs.
GM right now higher by 3.5%, call it 4% in the pre-market. Let's turn to our reporter out of London, Bloomberg's Craig Trudell. Craig, walk me through what GM is getting right and what everyone else seems to be getting wrong.
Yeah, I think the EV transition, they have not been without their bumps in this process, right? We you know, for some time, GM was trying to build up its own sort of dedicated EV and battery platform called Ultium. That didn't go particularly smoothly. Recently, the company has brought in a longtime former Tesla executive to run that side of the business, and he's making some major changes. I think the amount of product activity on the EV side is really ramping up. Next year is going to be a very busy year for them. And I do think that it's interesting that we're seeing sort of, you know, a reduction of losses on the EV side as they've really continued to just hit their marks and execute extremely well on the sort of old line business of, you know, making big pickups and SUVs that have long made them a lot of money and continue to be the main source of their profits.
Craig, it's not just the product mix, which is noteworthy this morning. It's also the regional breakdown. Lisa mentioned this quote from China, on China. In China, sales improved from the second quarter. Dealer inventory fell sharply. What do you think is going on in the world's second largest economy?
I think GM is really struggling, like some of the European names mentioned, in China, but I think they are trying to really sort of get their act together and recalibrate what that business is going to be going forward. And I think in broad strokes, what they want to do is stop competing in this sort of, you know, very competitive, you know, middle market there. They have a really strong business of low-priced vehicles, a business called Wuling that does quite well, and they want to try and move up market. That is not necessarily going to be without challenges. It probably means lower volumes there long term. But I think, you know, the outlook for international car makers in China is really messy given the sort of geopolitical forces. So it probably makes sense to sort of, you know, view the future in China as smaller and more strategic, and that seems to be where Mary Barra's head's at.
Craig, our perception, or my perception, is that European auto manufacturers' hands are more shackled to the idea that a significant bulk of their sales stem from China, and that they're really tied to that area at the same time that the walls aren't as high for Chinese vehicles coming into the Euro region. In the U.S., is it really fundamentally different, and is that part of why they can make bold moves and maybe make incremental gains, since it's not a major component of their overall revenues?
I think that's spot on, Reed. I also think that, you know, here in Europe, you don't have the sort of full-size pickup market and you know, full-size SUVs that do make GM and Ford so much money. And so, you know, you have much more of your business in the sort of, you know, smaller car, mid-size car segments. And, you know, while there has been some, you know, traction in terms of, you know, more SUVs that are higher margin, and these companies aren't without high margin business also in the luxury space. Even a sort of full line manufacturer like VW makes quite a bit of money selling Audis and Porsches. It is still just more of a slog in those sort of, you know, mass market segments where the Chinese manufacturers have just, you know, made a remarkable turn just in the last half decade or so of really being competitive in those spaces and making life really difficult if you're a European manufacturer.
Craig, how much is this truly a sign that GM is about to begin a new cycle of real growth, and how much is this them managing costs more effectively, them already right-sizing certain businesses, and frankly, they still face some of the upward shift to potentially higher labor costs and a real toggle at a time of transitioning technology that comes with production?
Yeah, I think it is more so the latter of strong execution and sort of keeping your business in order, as opposed to sort of being able to count on those go-go days in China ever coming back. I don't think that GM is necessarily even counting on EVs being the way that they make money in the near future. They're talking about reducing losses there and getting to where they're on a more equal footing with the rest of the business going forward, as opposed to that being where they make a big source of their earnings anytime soon. I do think also a key factor here is policy and the manufacturing tax credits passed by the Biden administration, and what the sort of outlook is for that business going forward, because there are potential for major swings in the way forward for the U.S. market in terms of whether or not stricter CO2 emissions limits stay in place that the Biden administration has implemented, whether or not the support is there for this EV and battery transition. It has not been without its issues, but GM is expecting to generate quite a bit of money from manufacturing tax credits, because they have these battery joint ventures in U.S. that are spooling up. It would be potentially a significant disruption if that support goes away, and if the CO2 limits that have been put into place are eased back down as happened during the first Trump administration.
Craig, that's exactly what I wanted to ask you. What does the future of their EV market look like? How many EVs they can potentially produce, and how profitable they would be if those subsidies start to dry up in potentially a red wave, maybe less so of Trump's presidency, but a red wave where they would actually have to change the law of the Inflation Reduction Act?
Yeah, I think we've seen a somewhat universal dialing back of, we need to recalibrate our expectations in terms of EV and battery production. We've seen that pretty universally across, the major automakers, GM and Ford in particular. I think we're sort of out front there. But I think if you look at those two companies and compare them, the amount of EV production, in the works, if you're GM, is significantly more than Ford. They have a lot more products coming to market, already in market. And, so the potential for a 180, I think, if you have to look at just those two businesses, it would be much more disruptive for General Motors than it would be for Ford if that support were to be dialed back.
Craig, appreciate the update as always, sir. Their stock is up by 3% in the pre-market. It's a beat and it's a raise, and it's a big thank you to the gas-powered GMC Yukon and Chevy Silverado in many ways.
Well, basically, this is a country in the United States where people like their trucks. The trucks tend to be higher margin businesses, and they've leaned into that. They are still working on their EV plans, but it's less dependent on that type of transition than, say, going out west in your pickup.
The US is doing better. Europe, not so much. Under surveillance this morning, car sales in Europe falling in September for the first consecutive monthly decline in more than 2 years. The European Automobile Manufacturers Association saying new car registrations fell 4.2% compared to a year ago. Stellantis posting one of the biggest drops. Check this out. Registrations plummeting 26%.
So is this an issue of execution? Is this issue of a structural shift, or is it both? And that's really what it seems like this company has been grappling with as they try to rejigger their entire executive framework. How do they come up with a plan, though? When we talked with Carlos Tavares, he basically said they need to come up with some sort of structure of incentivizing people to buy, of making it cheaper for them to actually manufacture in the Euro region. Otherwise, they are going to be permanently at a competitive disadvantage.
Europe has too much capacity. And arguably, maybe the world has too much capacity. And if the walls go up stateside following the election in this country, then there's only going to be one region that has to eat that capacity, even with those tariffs. And it goes beyond just the automobiles, by the way. So if you're going to get an inflationary shock, and this is a bit of a tangent, I know, just away from the car makers for a moment. If you believe we would get an inflationary shock from a Trump presidency in this country and a GOP sweep, you'd have to imagine we'll have somewhat of a disinflationary shock in the rest of the world, because the rest of the world has to eat what China's provided right now.
This goes to Peter Scheer's point, and he has been incredibly articulate on this. China's game plan to get them out of the economic malaise that they've been in is to overproduce and to supply the rest of the world, to be the manufacturer of the entire world. They've created the goods. Where are they going to go? If the walls are up for the U.S., they got to go somewhere else, and that means maybe disinflation, but at the expense of industries that are homegrown.
Which is why we see Europe either deciding they're going to put the walls up and there's negotiations about tariffs in terms of China dumping on their market, or places like Hungary are inviting Chinese auto manufacturers in to at least build in Europe. Because why? They need to, at the end of the day, also save jobs, which is the issue that VW is going to have if they want to decide to start shutting factory doors.
Saw a similar thing in Italy as well, with Giorgia Meloni, the Prime Minister there. Let's get you the latest on the Fed speak. I do not envy being a monetary policy maker right now through 2025. It is really, really difficult. San Francisco Fed President Mary Daly saying she doesn't see any reason to stop cutting interest rates for now. Other Fed officials signal they favor a slower pace of rate reductions, including Laurie Logan, Neil Kashkari, and Jeff Smear, and then things could change all over again in about 2 weeks' time.
The truth is, they all are saying the same thing, just from different angles, because even Mary Daly only sees 1 or 2 more rate cuts this year of 25 basis points. Neil Kashkari talking about how he wants to have 25 or smaller rate cuts rather than the outsized one that they began the cycle with. This is all basically different sides of this idea that we don't want to make bold moves. We're moving incrementally, but we still are well above the neutral rate. This, of course, goes back to what is neutral, how far can they cut, et cetera, et cetera. I feel like they're all dancing on the head of a pin at a time where we're all just vulnerable to economic data, and that, I think, is what we're feeling from their commentary.
Which is why the jobs report is going to be so important. That comes before the next Fed decision. It comes before the U.S. election. And what Mary Daly said is that we already know that we're on a path towards 2% when it comes to inflation. She said, I don't want to see the labor market slow further. So you had that exceptional labor market report that obviously started to spur up these concerns about maybe the Fed cut too much. Maybe the Fed doesn't need to cut anymore. But if we get a really weaker labor report, potentially then we'll see it swing in the other direction.
November 1. 9 estimates are in our survey. Sneak peek, 140 is the estimate. 140K. I'll give you the high and the low at the moment. The high is 160. The low at the moment is 75. 75 comes from Deutsche Bank, by the way. Governor Waller said 100K. The hurricane impact, some of the strike impact, you can take 100K off this number, maybe. I've seen estimates from anywhere between 40 to 100K. To see Deutsche Bank down at 75, you'd have to imagine that call from Brett Ryan is based largely on the hurricane disruption.
Which, to a certain degree, can be, I don't want to say discounted, but won't necessarily be seen as a trend of massive deceleration in the labor market. Again, it gets messy, so good luck, have fun. And I think that's the reason why a lot of them, Mary Daly in particular, was saying, ultimately, she's looking past this. It's not her major data point. She's looking at other factors, like some of the surveys, discussions, the qualitative data.
The Beige Book, things like that.
Exactly,
Yes,
that's the reason why it actually really matters.
Beige Book a little bit later this week,
Okay.
tomorrow. Yeah, you excited for that?
Oh, yeah.
I believe it's Wednesday, right?
Yeah, I believe it's Wednesday. For a second, I thought maybe it's today, but then I thought, no, 20-year auction, Beige Book. It's a really exciting.
That's how you think about things.
Yeah,
How
basically.
Bramo's
just trying
brain
to-
works.
yeah.
All right, let's get the latest from the Middle East. Secretary of State Antony Blinken back in the Middle East, meeting with Israeli Prime Minister Benjamin Netanyahu, as the defense minister is going to be meeting with him later today as well. The US hoping Israel's killing of Hamas leader Yahya Sinwar just last week may open the way for a ceasefire. Very little sign of that just yet.
Very little sign of that, and you have to think they are